We've been calling this year a tale of two markets, but there's also been a tale of two economies, especially on the consumer side.
We're also seeing a slowdown in spending. We are talking about the softening of the consumer a little bit more.
We're already seeing signs that the economy is cooling. We think that continues and starts to have a bigger impact from a fundamental perspective.
I think this is going to be the best earnings season in 2.5 years. Earnings are going to be healthily double-digit.
The earnings have not been terrible. Granted, maybe the market got ahead of itself, but the story around earnings, the story around U.S. exceptionalism because of these companies is still retained in my mind.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now, coming into Tuesday on a two-day winning streak on the S&P 500 on the eve of the July Federal Reserve decision. Your price action looks like this. Equity futures on the S&P 500 just a little bit firmer by 0.1%. A similar move on the Russell. Likewise on the Nasdaq. The Nasdaq at the epicenter of this market a little bit later on this afternoon as we kick off Mag 7 earnings season for the week. This is what the calendar looks like. Microsoft today. Tomorrow Meta. Thursday Apple. Amazon. Lisa, this is what Savita Subramanian with Bank of America has got to say about all of this. The last 12 months were tell me, today is show me.
And that really is a reason why, when 13% of the market cap reporting just today alone, it's the reason why people are focused on whether there actually is the profitability in artificial intelligence that everybody thought there would be. Patience has run out for the promise, but not the dollars. And that, I think, is the message we've been getting.
It's investment versus monetization. That's going to be a theme we explore throughout this morning. Need to talk about the economic data as well. The first little taste of jobs data this week. The calendar for the jobs data looks a little something like this. JOLTS job openings a little bit later this morning. That's the first take of the labour market for the week. Then we go through the week. We get ADP tomorrow, claims on Thursday, and Lisa payrolls on Friday. The earnings and the data seems to be the two big focal points away from the Federal Reserve, which most people have just assumed they know what that's going to sound and look like tomorrow afternoon.
We are data dependent.
Something like that.
We are data dependent. Keep looking at the data, which is what you just talked about, the jobs data as well as the earnings. So far, it has been a confusing picture in terms of whether it's weak or just weakening. The weakening has really won out in this sort of Goldilocks world. With the jobs data, how bad does it have to be? And this is what a lot of people have been talking about, to either bring something forward in terms of a 50 basis point rate cut in September versus a bad kind of rate cut that signifies some sort of true weakness that even McDonald's was able to shake off. I mean, really, when you take a look at how the market has responded to sort of the warnings from companies, it hasn't been with much drama.
Are these cuts, if we get them and they start in September and we get a series of them, are they about disinflation or are they about growth or both? And that's something we need to be asking these guests throughout the morning. You mentioned McDonald's. Chris Harvey of Wells Fargo pointing this out. Just a series of quotes we've heard from corporate America over the last few weeks. The likes of McDonald's, lower income consumers are dropping out of the market. From Nike, softer traffic in North American stores. We've heard this repeatedly from a cross-section of industries over the last few weeks.
Matt Hornbach of Morgan Stanley is going to be coming up later, and he has the quote of the morning. The Olympic motto reads, faster, higher, stronger, together. It could have been used as the motto for central bank policies, inflation and growth in 2022 and 2023. Slower, lower, weaker, together seems a more appropriate description in 2024, and that is what a lot of the earnings have been pointing to. Slower, lower, weaker, together.
Can I raise you? Because I just saw this from ING. Someone just posted this on Twitter. The Eurozone economy is quite like the water quality of the Seine. Some days it may look okay, but overall it's poor enough to continuously worry about it. That right there is quite of the morning, right?
That's fantastic. If anyone doesn't know, they can sort of postponed some of the events with respect to swimming in the Seine because of water quality issues. So that is very apropos. This is confusing. You take a look at growth of the Euro region. We saw better than expected in the periphery. And guess where the disappointment came?
Germany.
That's what it has been all this year.
Yeah, negative growth. The euro just about positive. As Lisa points out, Eurozone GDP okay. Beneath the surface, though, some real division. The euro, 108.33. Let's get to the price action elsewhere. More broadly, equity futures on the S&P 500 just about positive by 0.1%. In the bond market, yields drifting lower on a 10-year for the previous three sessions. This morning, just about unchanged. Your yield 417.25. 2024. Coming up this hour, we'll catch up with Bob Dole of Crossmark ahead of key Max 7 earnings. Bloomberg's Michael Shepard as expectations grow around a Trump-Harris debate. And Aditya Bhave of Bank of America as the FOMC kicks off its two-day meeting. We begin with our top story, the growth rotation, taking a breather, going into Microsoft earnings after the closing bell. Bob Dole of Crossmark writing this: small caps typically outperform in the early stages of economic expansions. We caution against chasing these gains at such a late stage of the cycle, even though cheap valuations may offer some cushion. Bob joins us now for more. Bob, wonderful to catch up with you, buddy, as always. Let's look ahead to the earnings later. Microsoft kicks it all off for the Max 7 numbers that report this week. What are you looking for, and how do you gauge what investors are willing to reward and what they seem like they want to punish over the last few weeks?
I think the bar is high for these companies, Jonathan, and they're going to have to make those numbers more likely exceed them for the stocks to be okay. People are looking for excuses to trim these names, and they just reported. I own some of that. Let me trim it. I think that's the general trend in these names. Expectations high.
Dan Ives of Wedbush with even bigger expectations. He's looking for an even bigger rally in big tech. We believe this week and the rest of 2Q earnings will be a major positive catalyst for the tech sector. We expect tech stocks to be up another 15 to 20% for the year, adding to the robust tech gains in the first half of 24. Bob, what would deliver 15 to 20% upside for tech stocks? Where's that going to come from?
Therein lies the debate. That we're going to have a further leg in AI. We're going to have exceeding earnings expectations, earnings estimates moving up, in my view, to get another 15 to 20%. People own these stocks. It's not like they're undiscovered. So to buy more of them, we're going to need better news that it's hard for you and me to anticipate.
We should talk about the flip side of that, which is how much more downside could there potentially be in the tech sector. John was talking about Bank of America research saying time to show monetization. Since the first quarter, there is $9 expended in CapEx revision for every $1 in additional sales of hyperscalers. In other words, we're not seeing it translate into profits so directly. Are you seeing that as a reason to sell some of these stocks on an ongoing basis? Or do you think that's been basically what's behind the declines that we've seen so far?
I think that's what's behind the declines. That doesn't mean there isn't more of that to come. To repeat, though, people have big profits in these stocks, and they see other stocks beginning to move, and so to trim these to buy some of the others, I'm not convinced that rotation is over, which generally means for a sloppy market. As we've seen this rotation here in the month of July, the market's kind of moved sidewise as people are trying to figure all out. As you used the word earlier, it's confusing.
Yes, that's been the story of the entire year, the past couple of years. There is this issue. You said that you're not convinced that the rotation is over. The rotation has been curious because it's been marked by the companies that are most leveraged to the economic cycle at a time when we're talking about weakening, we're talking about cooling, we're talking about companies disappointing, and talking about consumers that are very price sensitive. How does that make sense?
It doesn't. In my view, I agree with your set of statements and trying to square the circle. Look, people have gotten very complacent, in my view. The economy is just fine. Earnings will be good. The Fed will get inflation down to 2. I'll hold my nose and buy stocks at 22 times forward, 26 times trailing earnings. That's a hard road for me to ride.
I have to say, Bob, I think everyone wants it both ways. When inflation was up and rates were climbing, we were talking about wider margins, better margins, because they had pricing power. Doesn't the opposite apply here, Bob? That when you start to see disinflation, even more disinflation in our future, it just means a loss of pricing power, which goes back to the point you're trying to make, which ultimately is, why buy cyclicals here? Isn't that the biggest headwind to that bet?
I think that's right. And the companies are waking up to the fact that they've moved prices up and they're starting to get resistance, particularly in the mid-income consumers. And that's new over the last bunch of weeks. And that can't be sustained without more weakening. So what do? They say, we got to cut costs somewhere, and maybe we won't hire a worker or two. Maybe we'll let a worker or two go. And that's why you're starting to get some sloppiness in the employment data.
So we've got a decent idea of what you don't like, what you want to stay away from. Give us an idea of what you do like, what you're gravitating towards.
I come back to the common factors of earnings persistence, earnings predictability, and strong free cash flow. That's my defense, if you will. against the kinds of things we're talking about here. Those stocks have done fine as the market has moved up. I think they'll show their stuff even more if we get into a selling squall or some sort of sloppy sidewise action.
Is there a reason why you just are focusing on stocks? Is that just because that was the conversation, or are you just trying to avoid bonds? That stocks are both the risk factor as well as the havens factor, depending on where you go?
Only because that's the conversation. I would own some bonds here. Look, the economy is slowing. While second quarter earnings have been just fine, third and fourth quarter earnings estimate revisions have been to the downside. So the sloppiness is kicking in, and when that happens, you probably won't want to own a bond or two.
Which kind? Is it something that you're worried about in terms of longer term or medium term is sort of the sweet spot, or do you think that right now it's time to lock things in?
I would own quality, meaning more treasuries than corporates and high yields. Look, corporate and high yield spreads are pretty tight, as you know. And if and as the economy weakens, the questions about how long will that weakness last probably causes these very tight spreads to widen some, and therefore the govies probably outperform.
Interesting. Bob, thank you, sir. Appreciate the update. It's good to see you. Bob Dole at Crossmark. You as well, sir. Big week ahead. Big week ahead full of economic data as well. I mentioned jobs numbers that come out later this week. Job openings a little bit later on this morning. Just a sneak peek of our updated survey here at Bloomberg for payrolls on Friday. The new median estimate down to 175. The previous number 206. A lot of attention being paid to what might happen with unemployment. Unemployment still expected to stick at 4.1%. Andrew Hornhorst of Citi, they've got a big call. They're looking for unemployment to come up to about 4.2%. They're looking for the rate of job growth to come all the way back down to 150. And the line coming out from Andrew and the team in the last 24 hours, Lee, so the labour market is on the edge of uncomfortable. That's the view from Citi.
Other people would agree, which is the reason why it's not just Bill Dudley coming out saying cut rates tomorrow. This is the time. Why wait? We've heard that again and again. Alan Blinder, the former Fed vice chair, came out in a Wall Street Journal op-ed yesterday, echoing what we heard from Bill Dudley, saying, why wait? I can make an argument for forward guidance wanting to be predictable, but look at all of these signs. There is no reason to hold rates at the level they currently are.
I've got that headline from the Journal piece right in front of me. The Fed should cut interest rates this week. So that's Bill Dudley, former New York Fed president. That's Alan Blinder, former vice chairman of the Federal Reserve, I believe, back in the mid-90s. That's Mohammed Al-Erin as well. Jan Hatzius of Goldman, he's not saying they will cut rates this month, but he asked the question as well, why wait? We've seen this repeatedly from quite a few big names over the last few weeks.
The flip side to the reason why they would not cut, and Alan Blinder said it's sort of, ridiculous. I'm saying they should. They're not going to. He basically acknowledged they're probably going to do it in September, but I want to raise this prospect. They don't want to catch the market off guard. They basically have been saying, we're going to telegraph what's going to happen. We want to sort of give you a sense and make sure that forward guidance is appropriate. Is that going to alarm markets and suggest that there is something that the Fed is seeing that markets are not, especially given that the rhetoric so far has been pretty cautious and balanced?
Yeah, I think if Bill was still the New York Fed president and he put out that piece, I think this market would have been spooked. This market was spooked anyway off the back of that piece. Can you imagine if he was still a sitting Fed official?
I think he probably wouldn't have written it. I'm just saying, Bill, you can correct me.
I agree.
Maybe tomorrow. Come on.
I agree. I totally agree. What you can say when you're no longer a Fed official, very different to what you could say when you were a Fed official. Plenty more on that a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The euro area economy grew more than expected in the second quarter, and GDP data out about an hour ago. Resilient expansion in key countries allowed the region to shrug off Germany's surprise contraction. GDP rose 0.3%. That was thanks to growth from France and Spain that beat estimates. Germany had a 0.1% drop. Shares of BP are rising in the European session this morning, about 1% after its second quarter earnings report. The British oil giant posted profit above analyst estimates from pumping crude, offsetting weakness in other parts of the business. BP also maintained the pace of its share buybacks and increased its dividend. And the men's triathlon has been postponed at the Paris Olympic Games. Much like the European economy, it was a concern about quality. Organizers cited insufficient water levels in the Seine River. The event was originally scheduled to take place this morning. It will now run on Wednesday at 10:45 a.m. local time, right after the women's race. The weather forecast does continue to point to risks of rain and thunderstorms, which could even further delay the event. And that's your brief, John.
Danny, thank you. I heard the Italian commentary yesterday. There was an Italian TV commentator.
Oh, I'm sure it
who
was...
said that the coffee at the press office was so bad in France it had been made with the water from the River Seine.
All right. Okay. Hold up. Pause. You can speak to this, actually. I'm not sure I'm going to be okay with this, or okay for saying this, but it seems like people in a certain country have a little bit of animosity toward another country.
None at all. None at all.
Or a sense of superiority.
There's clearly reasons to have a sense of superiority when it comes to Italian coffee over French coffee, no?
Sure. Okay, sure.
Right, good. We agree on that.
Just,
good.
Let's set that aside.
Up next on the programme, please we're all on the same page. Returning to the debate stage.
I'm leading in all of the polls. I'm leading big in all of the swing states. And I say this. The answer is yes, I'll probably end up debating. I think actually the debate should take place before the votes start being cast.
That conversation is coming up next. I'm just saying that Italy does a great job of making you feel wanted in the country.
Oh, so this has something other than just coffee?
No, I'm just saying. I'm not saying that in other countries that's not the case.
It's just
that's for other people to decide. I'm just saying in Italy it's just like welcome.
Okay.
Welcome from New York. Beautiful New York. This is Bloomberg.
It's not.
Wednesday, the Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Live from New York City, welcome to the programme. 2 days of gains on the S&P 500. We might add to that. We're up 0.1% on the S&P. In the bond market, we're going nowhere. The 10-year, 417.24. Under surveillance this morning, returning to the debate stage.
I've had a lot of debates.
But you're winning on all the issues,
But, you know, I'm leading in the polls by, I think, a lot. I don't know. I hear different numbers. But I'm leading in all of the polls. I'm leading big in all of the swing states. And I say this. The answer is yes, I'll probably end up debating. I think actually the debate should take place before the votes start being cast. So the answer is yes, but I can also make a case for not doing it. I would rather run against her than him. I think she's easier than he is.
Was that answer clear? Like, kinda. Here's the latest. So we've got momentum building towards the first possible debate between Donald Trump and Kamala Harris, slated for September 10th on ABC. The Harris campaign moving forward with its search for a running mate. The shortlist including Governors Josh Shapiro and Tim Walz and Senator Mark Kelly. Joining us now is Bloomberg's Mike Shepard. We understand Mr. Roy Cooper of North Carolina will not be in that race anymore, Mike Shepard. Can you just start there for us? Who's in the running to become the VP? Who's dropped out? And what kind of reason have we been offered?
Well, look, Jonathan, this is all moving so fast, and the campaign has very quickly had to assess up to a dozen possible contenders to be her number two on the ticket. And they've had to do so very quickly. 3 names, based on all of our reporting here in Washington, have really risen to the top. And you've mentioned those. Arizona Senator and former astronaut Mark Kelly, Tim Walz, the governor of Minnesota, and Pennsylvania Governor Josh Shapiro. And each of them brings a special strength to this competition for Harris. They can try to bring in some of the swing states that Harris will need to win. Pennsylvania is an essential. Whoever wins the presidency will very likely take Pennsylvania, and Josh Shapiro could flip that state back into the Democrats' column. They have been trailing there in swing state polls, including Bloomberg's, over the past several months. Arizona is another critical state, and Mark Kelly's presence on the ticket could help on the immigration issue. And then Tim Walz, that Midwestern region of Wisconsin, neighboring Wisconsin and Michigan, he could also bring some credibility there. So that is really the calculus. Pete Buttigieg has also been mentioned, especially by his supporters and fans, as somebody who could argue well for the ticket, and he sure has done so since Harris has ascended to the top of the ticket. But really, those 3 men have emerged pushed to the front of the pack, at least where we are right now.
Can we just pick out the third name and build on that conversation just a little bit more, Mike? I think we're all quite familiar at this point with Governor Shapiro of Pennsylvania, with Senator Kelly of Arizona. It feels like, at least from here, that Governor Walz has seemed to have come into this conversation from almost nowhere. When Biden first dropped out, we had that list of names, and I didn't see Governor Walz's name on it. Where does Minnesota come into this? Why has this become a bigger part of the conversation in the last few days?
Well, it's become part of the conversation because Republicans have been targeting Minnesota as a state where they could make some inroads. They saw some softness among voters there for President Joe Biden when he was still on the ticket, and they thought that is a state we could take back. And by putting Tim Walz into play and by recognizing Minnesota as a place where we are going to hold our ground here, that also helps motivate voters in Minnesota and may also help fend off Republicans in that state. It's unclear, though, whether he has enough recognition, name recognition, that is, around the rest of the country. He is several years older than Harris, and she may want to choose somebody who is of her generation or a bit younger, too.
Okay. I was doing some research yesterday trying to answer the question, where did Tim Walz come from? And I read a couple of articles that basically he called J.D. Vance and Donald Trump weird, and that got the attention of the rest of the Democratic Party. Is that accurate?
I think that's fair to say that caught certainly caught the attention of people on the Harris campaign and elsewhere. But he also does have a sterling reputation in Minnesota. Some of the stimulus grants, they're known as Timmys back home. And he also has a reputation as somebody who was an excellent stump speaker. He's a former teacher. He used to have lunchroom duty, as he likes to say, and is somebody who knows how to command a room. And in that sense, he does bring that element. Now, whether he ultimately ends up as the Harris choice would be really interesting to see. He would be a different pick than maybe what we're expecting here.
In the meantime, Joe Biden is still trying to govern, and this is sort of a key question. What can he actually get done? Yesterday, he came out with a series of pretty sweeping reforms for the Supreme Court. A lot of people saying that they're pretty much dead in the water. Is that accurate, or any of these reforms something that, these proposals, something that could actually take off?
It's fair to say that they're not going anywhere this year. This is more messaging to the Democratic base, especially the progressives who have hammered and clamored for this for a number of years, and especially with some of the recent revelations about the disclosure of the gifts and other goodies that have come to certain justices' way, including Supreme Court Justice Clarence Thomas. There have been calls to change the way the court is run, and also to maybe even impose some age limits. It's unusual to hear the 81-year-old president calling for those kinds of term limits, but here we are. And the president knows full well that this is not going to go anywhere in the House. We've heard Mike Johnson express his reservations, and many Republicans too, and it is the kind of hard thing to get done in any time of year, but especially with just a few months to go before the election.
Shep, wouldn't this call have just a little bit more credibility if it was made by a Liberal president at a time there was a Liberal majority?
It certainly would, because then you would see the mandate in Congress as well as the White House to really propel this through. But we are in such a narrowly divided political atmosphere here in Washington these days that doing something, even if it sounds good on paper and may have mass appeal, if you talk to many Americans, their questions and doubts about the credibility of the Supreme Court, they're pretty evident. Now, what to do about it is a different matter, and we see that on so many other really thorny issues as well, ranging from spending and taxes to the execution of foreign policy overseas. These divides are sharp and they're real, and it makes it hard to get the hard things done.
Shep, appreciate your input. Thank you, sir. Mike Shepard there down in Washington, D.C. on the latest. And just to underline what Shep had to say at the end there, the very fact that we're talking about Governor Walz is not about some kind of policy initiative. It's to your point. The word weird is more effective in campaigning than any kind of policy initiative.
Welcome to 2024. I mean, this is the reason why I have to be honest, and this is personal, and this is my personal bias. My eyes glaze over sometimes when we're not talking about policy because it's name calling. And as much as I enjoy name calling, I deal with it with my children enough that I don't really feel the need.
You're going to have very glazed eyes for the next few months. You realise that, right?
Sounds like fun.
These cycles aren't changing.
I know.
Anytime soon. Coming up next on this programme, we'll catch up with Tom Shapiro of GTIS Partners on the state of the housing market ahead of tomorrow's Fed decision. From New York, this is Bloomberg. Kicking off the week with 2 days of gains. Friday into Monday. Haven't seen that for about 2 weeks on the S&P 500. That's how choppy things have been. This morning, up by another 0.2% on the Nasdaq 100, up by 0.2%. On the Russell, the small caps, a little bit of outperformance there, Lisa. Up by 1/3% going into those earnings through the morning and into the afternoon.
What I thought was interesting yesterday was that the Russell 2000 did not outperform, which was actually notable at a time when you saw a bit of a recovery. It really came from big tech. At this point, we are seeing that reversal back to the rotation trade, but it just highlights how uncertain the lack of conviction underneath just how much the internals are going to shift.
That's the stock market story. Let's turn the page, switch up the board and get to the bond market. The 2-year, 10-year, 30-year shaping up as follows. And we'll sit on the 10-year maturity just for a moment. 10-year yields lower for 3 consecutive sessions through yesterday. Back to levels that we haven't seen since around March time, around 4.15 yesterday. Back to about 4.17 this morning, 4.42 on a 30-year, on a 2-year about 4.39. Just for the shape of the yield curve, we'd seen this bull steepening through last week, so the front end really rallied, and then yesterday we saw a bit of a bull flattener. However way you chop it up, Lisa, ultimately the takeaway is this: the whole curve has dropped lower over the last month or so.
And it highlights how we don't really have a sense of what's going to drive it. You know how yesterday I was obsessed with the quarterly refunding announcement? Well, it came out, it was exactly the opposite as I thought it would be. And it's actually the U.S. government set to borrow less than expected, to the tune of about $740 billion versus the expected $847 billion. Why? Is this because the U.S. is doing so much better with its deficit? No, it's that basically they needed to reduce cash piles ahead of some kind of debt ceiling debate because that is required under law. So it basically just increases the chance of a default if they don't end up getting anything passed. Basically, it highlights why this is difficult to get right.
Increases the chance of a default that ultimately we probably won't see because we never do.
Correct, which is the reason why yields went lower, because they were selling less debt.
As always, the bond market making sense there for you. Switch on the board and get to foreign exchange. The euro looks like this, 108.35. If you looked at Eurozone GDP, on aggregate, Eurozone GDP was OK. If you looked at the breakdown from country to country, France, Spain, Italy, all positive. The negative, Germany. Germany has been a struggle for a while. It continues to be a struggle. The euro might be positive this morning, but Germany's got problems.
Yeah, negative 0.1% versus the expected positive 0.1% growth. This is the question for Germany. Is there anything structurally that they can do to really revive some of this growth? And frankly, reclaim the name as the engine of Europe, because right now it's anything but. And you're really seeing it in the peripheral regions with tourism, with a lot of their other types of services and goods. This is a real issue. Where is the growth going to come from, if not from Germany in a major and long-term way?
Germany was the engine of Europe, and the engine of Germany was China. And China's struggling. And companies with exposure to China, directly and indirectly, some of the luxury firms internationally are not getting that tourism. They're not getting that demand. We've seen that repeatedly. You're seeing it with some of the auto manufacturers who are struggling to compete in what must be the most competitive market on the planet in any industry, which is the EV market over in China. It's a struggle for a lot of people with exposure to that economy.
And it's unclear exactly how to deal with some of the slowdown that they're seeing. Do they more aggressively court consumers over in China? Do they open the doors to Chinese companies to come into their region to lower inflation with the hope that in return that it'll be reciprocal and they'll be able to sell into China? These are all kind of angst-provoking questions in Germany at a time when a lot of people are saying that the Chinese don't play on fair ground. And Germany auto manufacturers, when you talk to them and you say, can you really say you're not going to sell into China? They will tell you, behind closed doors, that is about half our profits, if not more.
Yep.
How could we possibly do that without completely reshaping our industry?
They need that market. For sure, big time. Under surveillance this morning, some top stories for you. Earnings a little bit later. Microsoft reports after the bell today. The results expected to show strong growth in the company's cloud computing unit, with investors focused on whether the billions spent to develop AI features will pay off. It's a show me the money quarter, according to the likes of Bank of America, Savita Subramanian. We've seen this with the likes of Alphabet. We're going to see it potentially later with Microsoft.
And Bank of America had this statistic. For every $9 added to CapEx revisions, so more than people previously expected, there was only $1 extra in sales for hyperscalers that was associated with it. So this is the issue. You're seeing the investment, but not the results. At the same time, isn't this what investment is for? Doesn't it take more than a hot second to actually come to fruition?
In an ideal world, yes, you have to wait.
So is this just basically people looking for an excuse to shed some exposure? Is this basically us creating a narrative around something? Because how many people can we get on who say, yeah, I'm disappointed, it's too late, over, story's ended?
Patience. I think we had a guest earlier this week from KKR who drew the parallel between building out the cloud business all those years ago and the same criticisms that we're hearing now about the AI business. It takes a while. And the pushback we got from Alphabet and the C-suite in the last week, they were pretty clear. Sundar Pichai came out and basically said there is a bigger risk here, under-investing in this, than the risk of over-investing. What you want to be doing here on the margin is overinvest if you need to. Certainly do not underinvest, because that will be painful in years to come.
Yeah, and people who draw the parallel to the tech boom, the internet boom of the early 2000s, it's not exactly analogous, because these companies are minting money and they're delivering profits way above what we saw from a lot of the companies back then. So they already have businesses. In terms of the transformation, there are real questions about how quickly and how dominant some of these players will and can be. I don't know that that can explain the whole story, though, given the fact that they still are exceeding expectations and minting cash.
Should we talk about the BOJ and not just the earnings? Central bank decisions coming up through this week. Two-day meeting for the Federal Reserve kicking off a little bit later this morning. The BOJ very much in focus. Details of its quantitative tightening plan, a rate decision tomorrow. A Bloomberg survey showing 14 of 48 economists predict the BOJ's board will raise interest rates. So consensus ultimately still expecting rates to remain unchanged. But there is a group of economists there who are looking for that interest rate hike tomorrow.
Yeah, and here's the issue to me that I wonder how much is baked into the market. What kind of disappointment will get played out in markets with respect to a weakening yen if the Bank of Japan does not make a move? And can the Bank of Japan offset inaction with the idea of possibly not buying as many bonds through its quantitative easing program? That, to me, really highlights how high the stakes are at a time where you are seeing some yen strength finally, which is a huge relief to authorities who have been talking about this.
A bit of weakness on the screen this morning. Yen strength over the last few weeks, that's for sure. Weakness this morning, 154.82. That currency pair higher by about 0.5%. The final story for you here, the FOMC kicking off its two-day meeting today as traders brace for a Fed decision tomorrow. The central bank widely expected to leave rates unchanged and signal a September rate cut. Tom Shapiro of GTIS Partners, a global real estate investment firm, writing this: the Fed should have enough comfort soon to start cutting rates. The worst of housing inflation may have occurred months ago. Tom joins us now for more. Tom, welcome to the programme. Let's start with housing inflation. And let's start here. Provocative question, I know. How big is the spread between shelter as measured in some of these indexes that we read inflation and the real world? How big is that spread?
Thanks so much for having me. It's big. So just to put it in perspective, shelter is 1/3 of CPI. The Fed is, the CPI numbers are showing up 5.2% in June. That is just not the real world. So CPI is at 3%. If you include housing CPI, it's at 1.8%. We own a lot of rental property. I can tell you that shelter is definitely not up 5.2%. It's flat to down. So why is that? So shelter really has two components. One is what's called owner's equivalent rent, and the second is actual rent. So 3/4 of the shelter component is owner's equivalent rent. So how is that determined? So they basically call people up and ask, if someone were to rent your home today, how much do you think it would rent for? Now, let me ask you a question. How many people really know the answer to that? I certainly don't. And so obviously you have a lot of miscalculation in the shelter number. So again, if you took shelter out today, we'd be below the Fed target of 2%. We'd be at 1.8%. It's definitely delayed. And there's no way that shelter costs are up 5.2%. So we'll see over the next 3 to 6 months that shelter number coming down to zero. And we'll definitely see CPI coming down to that level because of that. Because again, 1/3 of CPI is shelter.
So Tom, help us with this. Do you think we're past the cyclical bottom in real estate already? Is that behind us?
Yeah, we're already starting to see some signs of that today. Look, we've seen tremendous impact in CRE pricing. So overall valuations are down 21%. Office, of course, is the worst of that, is down about 37% to date. And that's, of course, because of the demand shock given work from home. And if you look at office in, say, San Francisco, Chicago, New York, the B buildings there are down 60, 70%. So we are already starting to see people anticipating a increase in pricing. So we're starting to see what cap rates are, which are what the investor expected yield is, already starting to come up in some of these markets. So cap rates starting to come down. So pricing is starting to come up, particularly in multifamily. So, just to give you a perspective, multifamily, you could have traded a B multifamily 3 years ago for 3.5% cap rate. Today, it went to about 5.5%. We're starting to see it come down 5.25% today. So it's really not a huge amount, but I think we're starting to see it come back. But, you also have to look beyond just interest rates. Of course, you have other factors as well. As I mentioned, you have work from home issues from the office perspective. You have expense issues. Certainly insurance has come up dramatically, taxes. Of course, wages are factoring in. So we're starting to see OpEx issues in some of our properties. So there's obviously more to it than interest rates, but interest rates are a huge component because if you had a floating rate loan, your cost of your mortgage just doubled.
And Tom, you point to particular markets that have benefited pretty dramatically during the pandemic, whether it was Florida or Texas, and how you've seen a real flattening out in terms of home price values, as well as an increase in builder incentives to bring people in to new constructions. There is a theory out there from a lot of people who join us that as soon as the Fed cuts rates, this all reverses. You start to see that pricing pressure once again reassert itself because there is just so much demand and still a chronically undersupplied housing market. Do you agree with that?
Somewhat. Interestingly, home building has been the darling, and it's gone through basically the whole downturn without unscathed. And that is, of course, because there's very limited supply, because if you have a 3.5% mortgage, you're not selling your home. So the amount of homes on the market are less than 1 million of existing homes. So that's been the issue. But there's a little bit of a double-edged sword here, because on the one hand, if interest rates get cut, it's obviously positive in the sense that it makes housing more affordable to buy. But in the other sense, you're going to see more inventory come on the market. So we are starting to see, actually, for the first time, a little bit of weakness in home building. I don't think it's going to be dramatic, but incentives, as you point out, for example, in Texas and Florida, are now at about 6.5% versus what they were at 4.8%. And mostly what the home builders are doing is they're using, basically their playbook has been to use the incentives to buy down mortgages. So if you buy an existing home, you're paying 7% on your mortgage, but through a home builder, you pay 5% because they're buying down the mortgage for you. Because people obviously look at what their monthly payments are and what they can afford. So I do think that it's not going to necessarily mean that home building is going to shoot right back up, because it's been such a dramatic really positive market for so long now. I mean, we've been seeing this for over a decade, and it's been our largest investments to date. So we're certainly not stopping investing in home building. In fact, we really like the sector a lot, but I do think we'll see a moderation a little bit.
Just to put this all together, Tom, when you first started talking about how you expect housing inflation, renter's equivalent rent in the real market, as basically falling to zero at this point, or very close to it, or at least in that direction, it would argue for rate cuts, that essentially this is restrictive policy and that it's actually reducing inflation more than some people would estimate. But when you then talk further about just how much there could be renewed bout of inflation with home prices going back up as soon as the Fed cuts rates, it raises a question. Is that basically what you're arguing for, that this is basically a sufficiently de-inflationed economy, the Fed can cut rates? Or is it just highlighting the dynamic and how sensitive the housing market really has gotten at this point to rates?
Well, keep in mind, home prices are not in the CPI because it's viewed as an investment. So again, it's rent that is. So just because home prices go up doesn't mean your CPI goes up at all. So I do think, again, there's going to be a little of a push-pull here in the housing market. It's been so strong, but if rates keep coming down, now I'm not talking about a 25 basis point rate cut, because who cares? But if we start seeing dramatic rate cuts, you're going to start to, you see a lot of people who actually want to sell their home, but how do you sell your home when you have a 2.5% or 3% mortgage? And that's been the real hang up here. So I'm not quite sure it's going to play out that way. I think we're going to see a pretty good housing market, probably not as good as people think it's going to be. And I don't think that means that housing prices are just going to shoot to the moon now. Again, because we're going to see supply finally coming on the market. We have the most anemic supply we've seen in decades on the market of existing homes. So I do think it's going to change, and we're going to start to see some supply on the market. So that'll counterbalance the demand side.
Hey, Tom, love this. Got to do this again soon. Let's get you in the studio. Tom Shapiro there of GTIS on the housing market and the spread between the data and the real world, which apparently, Lisa, is pretty wide.
Yeah, especially considering the fact that when somebody calls you up and asks you, what could you rent your apartment out? You're like, $1 million a month. Do you want to buy? I mean, really, at what point can people accurately assess how much they could actually get on the market?
It's like you, Mitch, inflation expectations.
I knew you were
Tell us what you think.
I knew you were thinking that. And you would totally skew it. I mean, if someone called you up and said,
totally.
What should the rent be? It depends who it's talking, if it's your person renting to you.
So excited.
Yeah.
I'm a renter. If they called me, I'd be like 20% lower than it is right now, that's for sure.
$5.
Let's get you an update on stories. We wish, right? Elsewhere this morning, with your Bloomberg Brief, is Danny Berger. Hey, Danny.
Hey, John. Standard Chartered shares are gaining this morning, up nearly 6%. Earnings beat estimates, and it expanded its share buyback program. Standard Chartered will now repurchase a record $1.5 billion. It's looking to return at least $5 billion to shareholders by 2026. Shares have advanced 9% so far this year. Now, on the other side of things, Diageo is tumbling. Shares are at their lowest level in 4 years with a drop of 6.7%. The British distiller reported its first annual sales decline since the pandemic. Diageo said that customers have chosen cheaper options in markets like Latin America and still have a stockpile of spirits built up from the post-COVID era boom. The maker of Johnnie Walker does expect a challenged consumer through 2025. And Tesla is recalling 1.85 million vehicles over the risk of software failures in detecting unlatched hood. An unlatched hood could fully open, obstructing the driver's view and raising the risk of a crash. The National Highway Traffic Safety Administration says that Tesla has released an over-the-air software update to fix the issue. The impacted cars include certain Model 3, S, and X vehicles made between 2021 and 2024. Plus Model Y vehicles starting in 2020. And that's your brief, John.
Yeah, that's a problem. Danny, thank you. More from Danny in about 30 minutes' time. Pretty cool that you can fix it over the air, though, right? That you don't take it in. They just send an update.
Program it not to fly up
cool.
into your face.
What was it programmed to do that? Anyway, all right. More on that story later, maybe. Up next on the program, the Fed's balancing act.
The risk, and rightly so, and the Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue. Powell has said it many times. They're not going to wait to get to 2% year over year on PCE or core PCE until, it's mission accomplished.
Kevin Gordon was great yesterday.
He was.
Really enjoyed that. We'll get the view from Bank of America up next on the program. Live from New York City, from our global headquarters. Welcome to the program. Just a flavour of the price action for you. We look like this on the S&P 500, firmer by 0.2%. Yields lower for a fourth consecutive session now. We're down about a basis point on a 10-year 416.66. Under surveillance this morning, the Fed's balancing act.
The risk, and rightly so, and the Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue. This is the part where you try to figure out and suss out what's the actual inflation rate that they become more comfortable with. Powell has said it many times. They're not going to wait to get to 2% year over year on PCE or core PCE until, it's mission accomplished.
Here's the latest this morning. The Fed's July meeting starting today. Investors expecting the Fed to leave rates unchanged and signal a September rate cut tomorrow. Attention also shifting to the labour market ahead of US payrolls on Friday. Aditya Bhave of Bank of America Global Research writing this: with smaller deviation in inflation and employment from target, the Fed's attention can be more balanced. Cuts can happen because the economy cools, because inflation slows, or both. Aditya joins us now for more. Aditya, good morning.
Morning.
Really good to see you. I know you've still got a base case of December with a little bit of a tilt towards September.
Yeah.
Just walk us through the base case. Why December still? And that last line in your quote, I think, is really important. This can happen because the economy cools, because inflation slows, or both? Just give us your sense of things right now.
Right. So our point right now is that September is not yet a done deal. And you can just think of that in terms of the dual mandate, right? So you look at inflation, you had 4 months, the first 4 months of the year, where inflation annualized more than 3% every single month. I'm talking about the core PCE. Then you had 2 good months. And for sure, the drop in housing inflation was helpful. If that continues, I think it'll make September very close to a base case. But it was 1 month, right? And then if you look at the activity side of the data, 2.1% GDP growth over the first half of the year. That's trend-like, if not slightly above trend. The unemployment rate is a point of concern, but most other activity indicators still look pretty solid.
We should draw a distinction between what you think they will do and what others think they should do. Can we just talk about the should argument? Alan Blinder, former Fed Vice Chair, former New York Fed President Bill Dudley, Mohamed Al-Arian. We've got name after name, some big names in the world of economics saying they should be cutting this month. Do you have any sympathy with that view?
So I think if they cut this month, they would indicate a sense of panic, right? That something is fundamentally broken in the economy. And that just doesn't seem to be the case if you look at the broad data, right? Again, going back to GDP growth, 2.1%. You're adding jobs according to non-farm payrolls, roughly around trend. So this looks like an economy that's decelerated from above trend growth in the second half of last year that was never sustainable, 4%. To very much a trend-like economy. And that's the sweet spot, as Governor Waller said. And it sounds like his base case, at least as of a couple of weeks ago, was actually that they don't want to cut in September.
That said, Aditya, there's the idea of what the signal is to markets, and then there's the idea of what the policy actually does, sort of de facto to borrowing conditions, and whether it's appropriate at this point, because of slowing growth, to have a lower Fed funds rate. Are you sympathetic? Stripping out the market's reaction, are you sympathetic with that view that there is no need to be worried about runaway inflation or reacceleration in inflation, or this idea that it's not been killed, that the genie is still out of the bottle? Are those arguments sort of gaining favor with you?
So for sure, we were much more concerned about reacceleration at the start of the year. Things look better now. That's why we still think that they do cut this year. And September is a pretty reasonable base case, right? Our point is just that it's too early to call that a done deal. If you do get, let's say you get strong payrolls on Friday, and then you get an above expectations inflation number around 25 basis points on the core PCE for August, or for July, right, in August. That's going to make the case much harder to cut in September, because why are we cutting?
I guess that the flip side of this question is how close are we to this idea of weakness rolling over to weak? This idea of some of the commentary that we're hearing from companies becoming something deeper, where basically you do see a consumer that is strapped and unable to spend more. How far away from that are we?
Again, it's difficult to tell in the early stages whether this is just a normalization or this is the economy rolling over. Our base case is that the economy is normalizing, not rolling over, with the caveat that there is some risk always that things could be rolling over. So when we look at the consumer, things seem to be, again, holding up fine, right? You look at consumer spending in the second quarter, all of the components looked okay. It wasn't just one component that was holding things up. And this was despite some issues with auto sales, for example, which are a big driver of fluctuations in consumer spending. Those were soft in June, will probably get payback in July. So overall, things look fine. They don't look super strong, but they don't look super weak either. We've had kind of an above consensus view on the consumer for a while, and we're happy to stick with that view for now.
You mentioned the payrolls report on Friday. There is a possibility that unemployment gets to about 4.2%. Right. That is the estimate coming out of Citi. They say the labour market's on the edge of uncomfortable. Goldman Sachs offering a list of reasons as to why we shouldn't fear higher unemployment. Here's a couple. There has not been an increase in layoffs that could trigger a vicious cycle of income loss and reduced spending. And a second point they make, the Fed has 525 basis points of room to cut if necessary, and no reason to hesitate. Should we be comfortable with what is increasingly looking uncomfortable in the labour market?
So what's interesting about the increase in the unemployment rate, while it certainly is a point of concern, is that some of it has come from flows from outside the labor force into unemployment rather than layoffs, as you mentioned, right? Which would be flows from employment into unemployment. So some of the increase in the unemployment rate has probably happened for good reasons. You don't want to put too much weight on that, but it is certainly a reason why we've gone from a trough of 3.4 to 4.1%, with the economy actually still growing around 2.5%, 3%, right, over the last year.
Aditya, love this. It's good to hear from you and get the update. Aditya Bhave there of Bank of America on the employment report on Friday, the Federal Reserve decision Wednesday, and why they're still sticking with December as their base case, but that could shift to September.
And this above consensus view of the consumer, I thought was very interesting. The idea that when you take a look at the ongoing strength, it is pretty broad based, and there isn't this sense of falling off a cliff. We've heard that from a lot of people. That, to me, could potentially underpin the case for why the Fed isn't missing the boat by not cutting tomorrow.
The second hour of Bloomberg Surveillance up next. Here's the lineup for you. Mahajan of Edward Jones, Tyler Radke of Citi, Francisco Blanch of Bank of America, and Matt Hornbach of Morgan Stanley. All of that and more just ahead. From New York City, this is Bloomberg.
This is a Fed that is desperate to try and achieve that utopic soft landing.
Really, the Fed is going to set the tone for everybody else.
I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal.
The Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue.
I think this is the window. It's not going to get easier to make the inflation case in the back half of 2024.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now. From New York City this morning, good morning for our audience worldwide. Let's start with a flavour of the price action for you. Drifting higher once again for a third consecutive session on the S&P 500, up by a couple of tenths of 1% across the board here. Outperformance once more on the Russell. The small caps up by a third of 1%. Let's go through the day ahead with a little bit of purpose. We'll start with the earnings. Microsoft coming a little bit later. Then the bigger players through the week. We'll hear from Meta, Apple, and Amazon. And then for the data, the economic data, just the first taste of what the jobs data might look like through the week, with job openings coming up a little bit later this morning. But I keep hearing the voice of Mohamed Al-Arian all the time on my shoulder. I talked about this yesterday. Listen to the companies. And what are the companies telling us about the consumer right now? Never mind the economic data. Kimberly-Clark, McDonald's, Delta, Pepsi, a combination of the following: a loss of pricing power and a more choiceful consumer. And we hear the same thing again this morning.
From Procter & Gamble, the maker of Tide detergent, Pampers diapers, and Loves, which apparently they weren't able to innovate on because of supply chain constraints. Here they show that prices increased just 1% in the period compared with a year earlier. That is the lowest increase in nearly 3 years. So again, it's this loss of pricing power and a sense that in order to keep their customers, they have run out of room to keep jacking up prices in a significant way.
This is what we hear from Chris Harvey of Wells Fargo. It's a similar story. He's pointing out the same commentary, the transcripts from the consumer-facing companies for the second quarter in 24. Nike, softer traffic in North America. McDonald's, lower income consumers are dropping out of the market. The first sales slide from McDonald's reported yesterday since 2020. All of this is stacking up, which is why the likes of Mohammed is making the point that this Federal Reserve needs to make a move. Stop taking some comfort from what you might see on Friday in the payrolls report. Listen to the companies. They're telling you things are weakening.
They're telling you that they're running out of pricing power. Some people might say this was exactly by design, and this isn't a sense of weakening. You look at Procter & Gamble shares, they're up 16% this year. You take a look at McDonald's, they rose on the day because of the promise of a $5 meal. It's not that these companies are running out of room to keep making money. And when you take a look at what everybody has said, inflation tends to, when it comes down, cause margin compression because companies are not able to raise their prices as much as some of the increases in prices that they are absorbing. So some of this is de facto by design. And so how do you parse out what was sort of expected in a healthy cooling and what isn't? And I think that, yes, listening to the companies gives you a sense things are shifting. Is it a good shifting or is it a bad one?
I think the argument that's been made currently is that inflation has come down enough that we can have an insurance cut here, and they should do that, front load it. Get early. Don't wait for the economic data to weaken. Preserve what we have. If you think about the names, though, we mentioned this 10 minutes ago. These are some big names. Mark Zandi, Moody's, Bill Dudley, former New York Fed president, Alan Blinder, former Fed vice chair, Mohamed Al-Arian. The list goes on and on and on.
They're looking at the idea that the weakening is usually not just one point in time that then stops, right? If you see a labor market that is starting to cool, there is a good chance that there is more cooling ahead because there is a delayed reaction. And they're trying to get ahead of that and saying, let's set that into motion now. When you take a look at borrowing costs, there is a time, there's lag. Remember long and variable lags
Sure.
we've all seemed to have forgotten about? They're worried that that's going to come to the fore in terms of how high prices are, how high rates are currently, and that it will take time when rates come lower for really work through this sort of easier monetary conditions. And you do see a tightening in financial conditions just based on some of the recent sell-off that we've seen in equities.
I went through that list and lost a name, didn't I? I missed one out. Neil, I'm sorry. Neil Datta of Renmac. You belong on that list, sir, of course. Do you know what it's like?
Yeah, I know.
You know what
exactly.
it's like.
Get a move on.
Yeah, get a move
Time
on.
has come.
What about me?
Yeah.
Neil, you too. Equities right now on the S&P 500, positive by 0.2%. A little bit of a lift. We've had 2 days of this. Can we make it day 3? And the bond market, yields grinding lower for 3 sessions. Lisa, can we make it day 4? Yields dropping across the curve over the last week or so.
And it has been fueled by this idea that maybe the Treasury Department won't sell quite as many bonds as previously expected. It's also with this idea that, yes, inflation is cooling. And if you get this kind of commentary, do you get ongoing senses that the beast has been killed, which is what everybody was talking about. Today, we do get JOLTS, the job openings data at 10 a.m. Eastern. That's going to be pivotal. I mean, it used to not matter. People would say it was messy data, but now it matters quite a bit. And the more that the trajectory is significantly lower, that is the soft real-time data showing companies need less labor and they're not having trouble finding it.
Then it's ADP, then it's jobless claims, and then it's payrolls on Friday. Coming up this hour, here's the lineup for you. Mona Mahajan of Edward Jones with big tech earnings on deck. We'll catch up with Francisco Blanch of Bank of America with unrest erupting in Venezuela. And Matthew Hornbach of Morgan Stanley as the Fed begins its 2-day meeting. We begin with our top story. US stocks looking for a 3rd straight day of gains as the rotation out of big tech takes a pause. Mona Mahajan of Edward Jones saying there's still room for value, writing this. We believe this rotation has legs, perhaps not without bumps along the way. And more broadly, we see the theme of the broadening of market leadership in both tech and non-tech sectors continuing in the back half of the year. Mona joins us now for more. Mona, how difficult is that going to be when we hear from some consumer-facing companies that say things are slow and we're losing pricing power?
Yeah, thanks, Sean. And look, this is still a scenario where we see a soft landing in the economy. So yes, we are seeing a cooling, and that is coming through not only in consumption numbers, but as you guys noted earlier, the labor market shows signs of really cooling from a position of relative strength. But perhaps the silver lining is that we are cooling, but still positive in economic growth. So we see, not the 3.5% economic growth annualized figures we saw last year, but maybe it's 1.5% to 2% going forward. But those positive numbers still mean that we are executing a soft landing in the economy. That is one of the tenets you need in place in order for markets to be supported and for that broadening of market leadership to continue. You combine that with a Fed that looks poised to cut rates and inflation that will probably continue on this bumpy path lower. Those are some of the ingredients we'd like to see in order for this broadening to continue through year end.
So underlying this, there must be an economic assumption. Do you think the unemployment rate, although it's climbed a little bit, can stabilize in the low 4s?
Yeah, it does feel like our view is that unemployment remains below 4.5%. It is interesting to note we're at 4.1%, which is already above the Fed's 4% kind of forecast for 2024. That in itself, we think, and we know the Fed has been focused on both sides of its dual mandate lately, both inflation and the labor market. We think the Fed is looking more closely at this kind of uptick in the unemployment rate, the softening in the labor market. Keep in mind, one, that will probably reinforce Jerome Powell's message on Wednesday that perhaps they're set up for a set of rate cuts in the back half of the year. But two, that wage growth figure, which is starting to cool more meaningfully, has serious implications for services inflation as well. And that's the part of inflation that's been more sticky. So a cooling in that wage growth figure across the board for companies means a large part of their cost structure may be moderating to some extent. That is a good news for services inflation in particular.
A lot of this sounds pretty rosy in terms of just a soft landing and the idea that companies are maneuvering through this and still making money. Hasn't a soft landing, though, already been fully priced in?
Yeah, I think to some extent the soft landing has been priced in. We're seeing it in economic forecasts through year end. But there's still some concern that we may slip into a recessionary environment. We're hearing more and more of that, especially as we're getting kind of consumer confidence numbers slipping. You're seeing some PMI data that is back in contraction. And so that risk of a recessionary environment is not off the table, but in our case, it's not a base case scenario. So there's some uncertainty in the marketplace. What we will say is we're getting more bouts of volatility. We had another kind of 5% correction back in mid-July, and maybe we're stabilizing through that. But as we head towards the back half of the year and we think about, election season coming up, historically there is volatility ahead of that as well. And so I do think you'll see some nerves and anxiety in the marketplace flare up. But in our view, at least what the data is telling us now is that that won't translate into something more nefarious like a bear market or a recession on the horizon, which usually leads to a bear market. And so that period of volatility, we think, is the opportunity. If you haven't yet diversified and broadened your portfolio, you will get some opportunities probably in the months ahead.
Does that mean that you think that there's going to be a reversal of some of the rotation trade and that you'll see big tech reassert itself and then you can buy everything else? Or is this the idea that some of the less loved stocks now, the tech stocks that have been down some 12% in the past couple weeks, and you want to start buying those?
Yeah, I think it's probably a combination of both. But I think if you haven't yet, a lot of folks have kind of positioned themselves to be part of this tech AI trade. It's really been the darlings of the market for the last year and a half, really. And so only more recently have we seen that part of the market slip more meaningfully. And to some extent, a lot of investors remain underweight or at least don't have as much exposure to some of the value cyclical parts of the market that really may play some catch up and have started to play some catch up in recent weeks. We do think, though, when we look towards the back half of the year, if the theme for 2023 and the first half of this year was narrow portfolios are what will be winning, we think as we look towards the back half of this year into 2025, we think diversified portfolios is really the winning strategy. And so if you don't have exposure to one side or the other in a meaningful way, we would say, start using these periods of volatility as the opportunity to get yourself there. And keep in mind, those investors that are still kind of overweight CDs, money markets, cash-like instruments, also an opportunity to start kind of dollar cost averaging down into more strategic allocations in bonds and equities.
I do want to just run this by you. Bank of America's Savita Subramanian came out with a note, and she was talking a lot about how it's a lot of show me the money kind of moment in AI. But she also said this: valuation suggests paltry price return for the next 10 years, but dividends should contribute to healthy real total returns from here. Is that how you're viewing the world as well?
Yeah, I do think it'll be an interesting next 5 to 10 years in financial markets broadly. So, we've talked in the past about how yields, while they will likely come down, the Fed will cut rates, but we're not going back to the zero bound. So we'll probably get somewhere in, that 2.5% to 3% range on the Fed funds rate, which still means a 3 to 4% Treasury yield environment. And so in that backdrop, one, yes, valuations matter more. Dividends and value investing probably is balanced with your AI tech growth portfolios, but bonds also play a meaningful part of your portfolio. So we do think that the structure of portfolios will look a little bit different in the next 5 to 10 years. And that is actually a healthy thing, especially as you're getting closer to retirement. You're getting real income from areas like bonds, like high dividend quality players, in addition to your equity portfolios. So we do think that, equity profiles overall, they may soften a bit, but really a nice pickup in the other parts of the market, including bonds and dividends, to your point.
Hey, Mona, appreciate the update from you, the team. Mona Mahajan there of Edward Jones. I think we've also got to appreciate the update we're getting from corporate America. In fact, from corporations worldwide. We should go over this again. Kimberly-Clark, slower price increases. Procter & Gamble this morning, Lisa went through this, slower price increases, a loss of pricing power. We see the same thing on both sides of the Atlantic, from the airline business, from Delta United American, on the United States side of things. Over in Europe, we heard the same thing from Ryanair. Two of the biggest food and beverage companies in the world, Nestle and Pepsi, also indicating the same thing. Nestle, value-seeking behaviour among consumers. Pepsi, a consumer that is more challenged. That's the last few weeks. In 2 weeks' time, we'll hear from Walmart. And I wonder how much of this starts to show up in their numbers, how much better they're doing, how much business they're taking from some of the players elsewhere.
As they talk to people or they deal with customers who are trading down, who are looking for bargains, which has really been the reason why they've been able to accumulate a bigger market share. When you take a step back, there is a very clear message coming from corporate America and, frankly, corporations worldwide. A lot of consumers are getting sick of paying so much. These are some of the businesses that were raising prices by double digits. Kleenex, you're talking about toilet paper during the pandemic. Remember the hoarding of that period of time, Tide Pods, etc. There is a now question of, isn't this good? Isn't this kind of what we want to see to get inflation down to what we need? Or is it because, frankly, consumers are just flat out? And that, I think, it continues to be the debate and will for the foreseeable future.
They're losing pricing power. There was also this interesting note. I've mentioned Chris Harvey of Wells Fargo a few times this morning. He's asking this, whether the weakness is migrating up the income spectrum as well. It's not just the low-income consumers. Maybe it's the higher-income consumers that are pulling back too. Given what's been happening in luxury, and I know there's tons of execution problems with the likes of Gucci over at Kering, but this has been almost across the board in luxury as well.
You're hearing it on the margins. Just in general, people aren't upgrading to the same degree. LVMH, we heard this from. We heard this from the likes of Gucci as well. How much do you end up with a situation where everyone is feeling this sort of impending slowdown and are going to behave as such? At the same time, Aditya Bhave of Bank of America came out and basically said, we have an above consensus consumer call. And that's what we're seeing in the data. And you're seeing that in some of the credit card receivables as well. Not clear.
The economists are still constructive. They're still looking at 175 in our survey. 175,000 jobs said to come on Friday. We'll see. The payrolls report a few days away. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A quick check on Merck shares for you, down 1.7%, flipping from gains to losses in the pre-market. It did beat profit estimates. Its blockbuster immunotherapy drug Keytruda continues to dominate the market. Sales of that cancer medicine rose 16% in the second quarter. But Merck's full-year outlook was more mixed. It did up its revenue forecast by about $200 million, but it downgraded its adjusted EPS outlook. It said the downgrade was due to one-time charges it made from acquisitions. Warren Buffett's Berkshire Hathaway cut its stake in Bank of America again. The company disclosing its third sale of shares in this month. It means it's pared its massive bet of the lender by a total of more than $3 billion this month. Still, Berkshire holds almost 962 million shares. The filing show worth about $39.5 billion at Monday's closing price. Buffett is taking profits on Bank of America with the stock up 22% this year. And the men's triathlon has been postponed at the Paris Olympic Games. Organizers cited insufficient water quality levels in the Seine. The event, originally scheduled to take place this morning, will now run on Wednesday, 10:45 a.m. local time, right after the women's race. However, the weather forecast does point to continued risks of rain and thunderstorms, which could further delay the event. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, betting big on AI.
People who are frustrated and uncomfortable with the fact that there's been an enormous amount of spend need to just kind of take a breather. We still feel convicted that this is going to be the most powerful theme over the next couple of years.
That's the view from BlackRock. We'll get another view up next on the program, live from New York City this morning. Good morning. Just a really busy couple of days ahead of us. It starts with the economic data a little bit later this morning. Then after the close, we get tons of earnings through the week. And it starts with Microsoft. Equity futures right now on the S&P positive by close to 0.2%. Under surveillance this morning, betting big on AI.
People who are frustrated and uncomfortable with the fact that there's been an enormous amount of spend, but we still have an enormous amount more to go in order to really embed this technology in all of our different businesses, need to just kind of take a breather. We've been cutting tech a little bit since the peak we had in the mid-late spring, but we still feel convicted that this is going to be the most powerful theme over the next couple of years.
So here's the latest. A massive week of tech earnings kicking off after the closing bell with Microsoft. Investors waiting to see whether billions of dollars in AI spending is paying off. Tyler Radke of Citi keeping a buy rating on Microsoft with a $520 price target, but highlighting potential risks, saying an aggressive increase in capex spending could hurt longer-term trajectory if AI adoption is slower than expected. Tyler joins us now for more. Tyler, wonderful to catch up with you. This seems to be a bit of a theme over the last week, in fact, the last month. Can we just take a step back? What are these tech companies spending money on? And what are investors starting to lose patience with?
Yeah, good morning. Thanks for having me. So Microsoft is spending a lot in terms of their CapEx on AI. What does that include? It includes buying GPUs, buying land to build data centers, power, cooling systems, stuff that you need to operate these GPUs. Again, they are seeing enormous amounts of demand. Last quarter, they commented that their capacity was below where the underlying demand levels were. So in some ways, they can't build a lot of this stuff fast enough. What those end customers are doing, they are deploying things like Microsoft 365 Copilot. They're building a lot of these large language models to unlock value across a number of use cases across their businesses.
Tyler, you said the demand is there. The monetization effort, just walk us through that. What is the timeline for that really to ramp up just as high as, say, CapEx has done over the last year?
Yeah, so if you look last quarter, I mean, Microsoft had an enormous bookings quarter. They grew bookings close to 30% year over year. Again, total revenue is only growing about low double digits. So it's clearly they're booking revenue faster than they're actually recognizing. Again, these are from big corporate enterprise clients. This is from nation states around the world. Everyone is trying to get their hands on capacity to ultimately build use cases that involve large language models. Obviously, Microsoft has an exclusive partnership with OpenAI, which provides some of the most powerful foundational models across the space. So a lot of that is related to OpenAI, but the demand is pretty widespread.
Tyler, is it frustrating to you to try to come up with a 1 month, 2 month, 3 month price target at a time where we're talking about years-long investments in a technology that has not been fully realized in terms of its potential applications?
Yeah, so certainly our target price is a little bit further out. We take a 12-month view on target prices, but obviously when you have CapEx ramping up with this type of intensity and AI ramping up in terms of this contribution, there are a lot more uncertainties. But I think the important thing is what you're seeing from Microsoft is the valuation multiple hasn't massively expanded. We're still talking about roughly a 30 to 35 times GAAP earnings multiple. Again, that excludes stock-based compensation. So while there are additional costs that Microsoft is incurring as it relates to funding these data center projects, they are continuing to offset that with costs and efficiencies elsewhere in the business. So you're still seeing earnings grow, very nicely, and we think that can continue to support the stock. And we don't feel like things are overheated, especially relative to a historical view of valuation.
A lot of people probably are sympathetic to your view on this, particularly with respect to Microsoft. I do wonder, in the broader world of some of the software in particular that we're seeing and the investments that are being made, there is this fear or this sense that there aren't going to all be winners, right? That there have to be some winners and some losers from the AI boom, that at one point we're lifting all boats. So how do you parse through what is overvalued at a time where money is getting thrown at something that's not fully established?
Yeah, I think that the truth of the matter is that we're still very, very early in this space. So as I look outside of Microsoft and software, there's been a lot of concerns. This year has been really rough for a lot of software stocks. Is AI eating software? Is AI cannibalizing other parts of IT budgets? And I think the answer is it's possible some of that's going on, but there's also other factors at play. Obviously, the beginning of the year, we saw a lot higher interest rates than we expected. We saw some budget flush in Q4, which prevented a lot of software companies from having good bookings quarters in Q1. So I do think areas, as you think about big cost centers, things like contact centers, developers, right? Those are areas where you are starting to see a lot of AI have impact, automating code completion processes. So over time, those could have impacts on jobs and on the labor force. But it's still very early in terms of who are the outright losers within the technology space.
We will see how patient investors are willing to be a little bit later this afternoon. Tyler Radke of Citi. Tyler, thank you, sir. Looking for something like 520 on Microsoft. Closed yesterday at 426. If you go through the analyst community, just doing that on the Bloomberg right now, 65 buys, 5 holds, not a single sell. Earlier this morning, I mentioned Dan Ives of Wedbush saying there could be another 15 to 20% upside for the year for some of these big tech firms. If you look at the 12-month assumptions from the South side, the return potential is 18%. That's pretty much consensus on the South side at the moment.
And if you think that big tech is going to get back to where it was at its record highs just a couple of weeks ago, that's, it's down 12% already. So there's some of your payback if you do believe that it will reassert itself.
You asked the right question. Difficult. People just not willing to be patient over something that's going to be with us for a long, long time. The road is long.
I see that with Progeny. I want to get rich quick. It's like, good luck,
You want to say anything else about
that?
No,
that's good.
Okay. Equities right now on the S&P 500 firmer by 0.2%. 2 days of gains coming into Tuesday, looking to make it day 3 on the Nasdaq, up by 0.25%. In the bond market, something we haven't seen since the middle of June. 4 consecutive days of falling yields on a 10-year, just about. Down by almost a basis point on a 10-year yield this morning, 416.85. Lisa, the quarterly refunding announcement, bit of detail in the last 12 hours.
Yeah, it was about $100 billion less than people thought in terms of the total amount that was going to be borrowed over the quarter. The explanation for this, it sounds really bullish. Oh, yeah, that's so good. The economy is doing so great that the U.S. government's deficit's getting better. Nope, that's not it. It basically is that there's a lot of cash, and you can't have too much cash in the coffers heading into a debt ceiling debate because that is considered padding the books. So that is the reason why some people are saying there is this sort of adjustment. Make of it what you will, but yields were a little bit lower
Some of the
yesterday.
things you have to consider at the Treasury is just ridiculous.
I know, that's
it really is.
I actually really enjoyed reading about this because it's just kind of counterintuitive. It's not what you would think. Logically, you would think it's because they're in a better position, but no.
The 10-year around 4.15, the 2-year around 4.40. Yields a little bit lower at the front end of the curve by a single basis point. We'll sit on Europe just for a beat, just for a moment, just for a couple of seconds. GDP out of the Eurozone, actually okay. But when you break it down, it's Italy, it's Spain, it's France, doing all right. It's Germany that's not. And this has been a story, a theme for Europe for quite a while now.
Yeah, especially because they do hinge on China. It also, we just have to keep sort of reiterating, Germany has been slammed because of their dependence on Russian oil. They've shifted gears, right? They're now including more natural gas and other products from Qatar, as well as many others. Now they're highly dependent on China at a time where there's a real question about the national security components of that. It seems like Europe is increasingly breaking away from the U.S. in terms of its approach to China, taking a slightly different stance with the latest of, Giorgia Meloni, even, of Italy, heading over to China for a visit about how there could be a partnership.
The German model's broken.
Yeah.
We've talked about this repeatedly, relying on the United States for security, military security, relying on China for economic security, relying on Russia for energy security. Everything about that, those 3 pillars of the German model, completely snapped in half at some point in the last few years.
Which raises the question, what will be the pillar of growth in Europe if that is ultimately going to be an ongoing story that challenges the engine of growth for so many years, which was Germany?
That's the latest on Europe. German bond yields going nowhere. 236 there on a 10-year. Under surveillance this morning, our top story, former President Donald Trump saying he expects to eventually debate Vice President Kamala Harris. Trump telling Fox News the debates should happen before early voting begins. The Harris campaign saying she will be at the September 10th debate previously scheduled for President Joe Biden. So she'll be there and he won't be because he wants it earlier. Is that where we're at now?
You started laughing because you imagined her just showing up and nobody else there. I mean, the other thing that, you heard in that clip that we played earlier was Donald Trump was saying, okay, well, I can make an argument for being there. I said I'd be there. I could also make an argument for not being there, So it's sort of unclear exactly what's going to happen. He wants to change the network. Either way, it does highlight how we do have a very different debate stage, a very different presidential election. And really, it's a lot of throwing it up against the wall and seeing what sticks.
This is playing into the Veep stakes conversation, though. If we just go through the 3 names that are doing the rounds at the moment, I think we've got a graphic of that. We can do it again. Senator Kelly of Arizona, Governor Shapiro of Pennsylvania. Governor Walz seems to have come from nowhere. Minnesota. I find the Senator Kelly Arizona pick interesting. Interesting for the following reasons. Only a few weeks ago, when Biden was top of the ticket, Arizona was almost unthinkable. That was a hope, a wish and a prayer. And now it's something they can actually do, given where the polls have turned over the last few weeks.
Yeah, Jeanette Lowe talking about how it was all about the Rust Belt and trying to keep the Rust Belt. Now it's about even the Sun Belt and potentially turning those states. It will be an indication of exactly where the battleground is when we do get a sense of when the vice president is. What do you think of this whole like Veep stakes thing. I mean, like we're sort of people have to, go up, pitch their case, but not too aggressively because that seems presumptive. It's kind of like, this courtship bachelorette.
I think
out.
Donald Trump wishes he'd waited a little longer, but he couldn't because of the convention, if he'd had the time. I just wonder how much the experience of the last few months are going to change elections for the next few decades. Just if you can, you push your convention really, really late. When we've done the primaries, think about the primaries in 4 years' time, however many years' time when we have to do this again. Which party's going to do it, I don't know. But when we've done it and it's completed and they've picked a nominee and all the delegates are behind them before we go to the convention, how many people are going to come on this programme and say, I don't know, let's see how the polls go over the next few weeks. Maybe they'll change candidates.
Yeah,
maybe it gets changed again.
It's back to the future. That's how it used to be. And a lot of people would like to see it return to that, the idea of a truly an open convention. We shall see.
It feels like that's where this is all heading. Maybe that's the beginning of that. Let's turn to China. The latest on China, vowing to boost consumer spending in order to meet the country's growth target. Communist Party leaders also pledging to roll out new measures to support the economy without providing much further detail. A Bloomberg survey showing economic woes are weighing on the country's expectations for crude demand. We're starting to see this show up in commodities. We'll spend some time on this in a moment, not just in oils, but also in the likes of softs, commodities, soybeans, cocoa. We're seeing it there too. You can mention a supply story, but there's demand elements to all of this. Copper, I think, is the lowest since March this morning. All of this starting to come to the surface. Crude, the whole commodity complex, pulling lower.
I'll just throw this in as well. The idea of how they're trying to stimulate demand by cutting prices, or cutting borrowing costs, hasn't really shown signs of igniting true credit creation. It's a demand story. It is not a supply story. It is not a lack of credit story.
Balance sheet recession. They're kind of the things that need fiscal stimulus to address them. And
correct.
There doesn't seem to be a willingness to do that right now. Let's turn to the latest in Venezuela. Protests erupting in the oil-producing nation of Venezuela. Socialist leader and President Nicolas Maduro claiming victory over challenger Edmundo Gonzalez following Sunday's election. The country's opposition claiming it has proof of fraud and Gonzalez is the rightful winner. Joining us around the table is Francisco Blanch of Bank of America Global Research. Francisco, it's good to see you. Great to see you in the flesh here in New York.
Thank you for having me.
Let's get into this story. I'm not going to ask you about the political gyrations and what's going to happen with the vote and who should be and who shouldn't be the president. I just want to understand your understanding of the situation and what it might mean for crude supply in the months to come.
Well, so there's two elements to the Venezuela story. First, will the protests end up leading to potential disruptions, which clearly the market doesn't seem too worried about. As Lisa just pointed out, commodities are going down because it's a demand story, or a lack thereof, rather. In the case of Venezuela, I think potentially it could be a bullish factor if we get some disruptions on the supply side, but also a long-term experience. If there is a change of government in Venezuela, remember the opposition has run a campaign on three pillars. First, they want to reunite families. There's almost 8 million Venezuelans that have moved abroad. There's also an element of eliminating a lot of the price distortions that they've introduced in the economy. But very importantly, they want to privatize the oil and gas sector. So I think if we go down that route, because there's a change of government, I mean, we are getting a little too ahead of ourselves here, but if there was that change of government, you could have the unlocking of what's effectively the world's largest energy reserves. Let's not forget, Venezuela has non-conventional, but the world's largest. And again, we have so much more technology today that if that were to be the case, I mean, you could have an enormous growth in the country should that get to a point. But again, I'm not saying it's going to happen.
Granted,
we're very far.
I get all of that. This is a highly speculative conversation, and this is certainly not revealing any of your base cases or any of your calls. But I do think the scenario analysis is worth it. What is online right now from Venezuela in terms of crude, and what could be online if you do start to privatize and the world reopens?
Right, so Venezuela produced more than 3 million barrels a day of oil back in the day, pre-Chavez, right? So it's been on a slippery slope ever since the big strike that we had in Venezuela, in PDVSA, in 2002. In fact, the bull run in commodity markets that we saw in the 2000s kind of really kicked off with the PDVSA strike in 2002, which was basically the workers of the National Oil Company facing off against, back then, Hugo Chavez. And since then, Venezuelan production of oil has been rolling down, and particularly the last 10 years or so has really collapsed to levels, to a low of 500,000 barrels a day. And since then, we've recovered to give or take 750,000, 800,000 barrels a day. So it's a fraction of what it was. And back then it wasn't what it could be. So again, it's the world's largest oil reserves. Think Saudi Arabia, think Canada, think Russia, if you were to get that opening, right?
So given that this is speculative, this isn't what's driving prices lower.
No.
We were talking earlier that this is essentially a story of demand. This is a story of China and a lack of demand there. How much is it broader than just a lack of demand from China?
It is broader. I mean, you guys were talking a little bit about it before with Germany. If you look at the industrial economy globally, it's doing pretty badly. We've been waiting for lower interest rates and China stimulus to get the commodity complex back on track, and none of this seem to be coming together. You mentioned it yourself. I mean, the Communist Party leaders spent a week locked up trying to figure out what to do about the economy, and they came up with a 10 basis point cut to mortgages, which seems like, okay, maybe you need a little more than that at this point. But here's my take. I think they're all waiting for the U.S. election to play out because I think we're just 3 months away, and things could really change for China. So why use your dry powder? Why use the dry powder 3 months ahead relative to when you may really need it, right? So I think one of the most challenging things for China is that not only they have an issue about how to recycle their savings, which is very visible in some other commodities like gold, right? But also China has an issue of creating just creating domestic demand, and of course it has the issue of tariffs, right? Potential tariffs from the U.S., potentially from the Europeans, although that's as you pointed out, it's a bit of a different story there. But that's not really helping China. I mean, China's been historically a large exporting nation, and now it's getting hurt on the back of that.
But take a step back. Is this entirely a China story, or is this something bigger, especially at a time when we're all talking about infrastructure building in the entire developed world, and at the same time, copper prices have fallen down significantly. We've seen oil prices fall pretty consistently, even with the potential supply disruptions in the Middle East if things do become more kinetic. There's a real question here about whether we are overestimating or underestimating the slowdown in demand to build, to keep traveling.
Look, 100%. There's an issue here is that rates are still very, very high. We don't realize, I guess, because we've kind of gotten used to like rates being 525, 550, but rates are very high. I mean, they're really, really high. And they're high because the U.S. demand story remains very strong. But the higher the U.S. rates remain, the worse it's going to be for the rest of the world. And I think China also faces higher U.S. rates, and the rest of the world faces high U.S. rates. And as I mentioned, you have this combination of high U.S. rates, which are driven mostly by the services sector, right? They're not really driven by the manufacturing sector. Manufacturers would love to have lower rates, right, in this country. And the rest of the world's kind of struggling on that too. So to me, it reminds me a little bit of what was going on back in the 90s, where you just had high U.S. rates and a very strong dollar, and that wasn't helpful for emerging markets. And I think that's the policy mix that, frankly, will likely continue post-November in one way or another. But unless we start to get lower rates, I think emerging markets are really going to start struggling here.
We've mentioned a bunch of commodities that aren't doing so well. Yeah. You mentioned one that is. You said gold.
Right.
Gold's near all-time highs. What's behind this move, and how many clients are asking you about it at the moment?
So, believe it or not, gold is not as widely owned as you would expect, right? So, there's a couple different elements to the gold story. There's obviously central banks, which are all buying gold in droves because they don't trust each other. The freezing of central bank assets of Russia, right, really triggered an enormous expansion in central bank gold holdings. I mean, if you look back the last 30 years, two inflection points. 2008, global financial crisis, we went from seeing central banks selling gold to net buying. And then more recently, 2022, freezing of central bank assets of Russia, suddenly big jump in central bank holdings because of that action, which, a lot of people question the legality of it. So that's one big story. Second big story is really what's going on at the retail level. Europeans are selling gold. U.S. has been selling gold, if you look at ETF holdings, but the Chinese have been buying gold. And we go back to the problem of China. They cannot recycle their savings into anything productive because they went into housing, and the housing market went bust. They went into tech, and the stock market went bust. They went into factories, and then we started throwing tariffs at China. So I guess people are like, well, will I put my money in? well, I guess the Chinese central bank is putting money in gold. Maybe I should too. And so the central bank started to slow down their gold purchases, right? Which is interesting. So I think gold, like I said, is really a story around China retail buying and central bank buying. And it just goes to show how frail the global economy is and how much fracturing we have in the global geopolitical system today.
When you say don't trust each other, do you mean don't trust the United States? Is that an important distinction?
I don't think
because I'm thinking of that diversification away from the US dollar.
Right.
Is that the important piece of this?
Well, we always hear that, but the reality of the matter is the most pounding when you look at global currency reserves in the last few years has been the euro. Because remember, the biggest buyer of euros was actually Russia, right? Because Russia sold its energy to Europe in euros, right? For the most part. So the dollar has been kind of just fine. It's been the euro, but I think generally you could say G10. You could say Western world's been facing those challenges as the world's kind of fractured geopolitically. And I think pretty much every country that is not 100% aligned with the US and Europe has been veering off towards buying more gold, and that basically means every country, right? Even we've seen NATO allies like Turkey buying gold. We've seen allies of the US and the UK, Singapore buying gold. So if you look at the data, there's really broad spread gold buying.
Could do this all morning. Francisco, this was great. It's good to see you.
Thank you.
Do it again soon. Francisco Blanch there of Bank of America with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Park Fire, raging out of control in the Sierra Nevada foothills may have started with an act of arson. A man now in jail allegedly pushed a flaming car into a ravine. It then outran fire crews and exploded in size, becoming California's 6th biggest fire on record. Conditions have been building for years and bodes poorly for the coming months. 2 wet winters in a row covered the state in newly grown grass and brush. Then summer arrived with dry air and back-to-back heat waves, turning vegetation into fuel. Samsung is expected to report its biggest jump in net income in at least a decade. That's thanks to a major rebound in its semiconductor division. Samsung had lagged behind in that chip division. It appears, though, to be back on track, winning approval from NVIDIA to make memory chips for crucial AI services. Previously, there had been months of stumbles that allowed its smaller rival, SK Hynix, to edge Samsung out of the lead. And Amazon's Prime Video is undercutting Netflix on advertising pricing. According to the FT, Amazon is pricing its spots more cheaply than Netflix after introducing an ad-based tier to its platform 5 months ago. Amazon's arrival into the crowded battle for ad dollars alone had already forced rivals to reduce their pricing, sources told the outlet. Some executives cited Amazon's vast trove of user data, giving it an edge to serve more targeted ads. And that's your brief. John.
Danny, thank you. Up next on the program, waiting for September.
I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal. They're going to wait and make sure that the data kind of are reasonably consistent. But, it does sound as if they would like to cut in September and justify the market's views.
That conversation up next. You're watching Bloomberg TV. Live from New York City, welcome to the program. Under surveillance this morning, waiting for September.
I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal. They're going to wait and make sure that the data kind of are reasonably consistent. But, it does sound as if they would like to cut in September and justify the market's views. This looks like a layup in terms of meeting market expectation.
So here's the latest. The Fed's 2-day meeting kicking off as markets fully price in a September rate cut. Fed Chair Jay Powell is expected to give a soft signal for a cut, even with 2 more inflation and job prints on deck. Matt Hornbach of Morgan Stanley writing the following. Our base case remains for there to be 3 25 basis point cuts in 2024, starting in September through November and December. Matt joins us now for more. Matt, it's good to see you.
Nice to be here. Thanks for having me.
Great to catch up. Good to see you in person as well, Matt. Let's get straight into this. For a long time, I think you and the team have said soft landing. interest rate cut. We're looking for it to happen in September. What's been guiding that view ultimately for you and the team?
Well, ultimately, we do think monetary policy is positioned in restrictive territory, but it's all a matter of degree. There's been a lot of support for the U.S. economy coming from the federal government. Last year, we had a very large increase in the fiscal deficit, and that has ultimately fed through. There are multiplier effects. There's lags that this stimulus has had in the U.S. economy, and we're slowly coming off the boil. We're looking for a deceleration, but it's far from recession, and as a result, we think the Fed can take its time, which it has done, to begin the process of lowering rates, and now we're on the precipice of that process.
I want to push the economics view through the bond market and get the rates view from you and the team as well. Tell me if I've got this right. An argument for lower short yields, also an argument for higher long-end yields. At the same time, simultaneously. Is that what you're looking for?
Well, we're looking for the yield curve to steepen. So short-term interest rates coming down, longer-term interest rates maybe staying where they are, maybe going up a little bit, maybe coming down less than what we see in the very front end of the yield curve. But John, that's really more of a view on the uncertainty that exists post-general election. There's a lot of uncertainty. And it's not easy for me to see investors extending all the way out the yield curve while we're facing this tremendous amount of uncertainty, not just with respect to who wins the election or the control of Congress, but what types of policies are going to be implemented when. It's not just about fiscal stimulus, immigration policy, trade policy. It's also about when will these policies be implemented. There's a lot of uncertainty around that, and I just don't think that investors are going to feel comfortable going all the way out the yield curve until we know.
Which raises a question, especially to your motto. I quoted it earlier this morning. I love it. The Olympic motto is faster, higher, stronger, together. You think that the motto should be, that would have been applicable to central banks in 2022 and 2023. Now it's slower, lower, weaker, together, which is deeply inspiring. I am wondering if all the central banks are cutting at once, all things being equal, if the government wasn't sort of uncertain with respect to what policies the U.S. was going to propose, shouldn't long-term yields be significantly lower?
Well, I think ultimately that's where they will head. But there's a lot of time between now and then, and ultimately the pace does matter. If central banks only lower interest rates very, very gradually, which is something that you see in the Fed's communication device, the so-called dot plot, it's telling you, Lisa, that the Fed is going to go very, very slowly. It's not clear in that environment that long-term interest rates actually have to fall very much. But that's where the Morgan Stanley view differs. We think that the Fed is going to be lowering rates once every meeting. And when I tell that to investors, I get these wide eyes like, wow, that's an aggressive easing cycle. And we just don't think it's very aggressive as a starting point. It's not entirely clear that I would call it an easing cycle. Remember, the Fed needs to lower rates just to keep policy where it is today in real terms.
There's a real question underpinning this call, which is, where is the ending point? We talked to Ellen Zentner that, yes, it's more aggressive in the near term, but then it ends mid-year. It ends a bit earlier in terms of that rate-cutting cycle, right? That's my ultimate question. Are we truly resetting to a higher inflation environment where the R-star is going to be naturally higher, or are we not?
I think the jury is still out on that, and Ellen is fantastic. I think her Fed call this year has been wonderful. Forecasting what's going to happen in a month is hard enough. Forecasting what's going to happen in a year is that much more difficult. I think the jury is still out. I think we can have a reasonable debate about where interest rates need to be in the medium to long term to keep economic activity running at a rate, importantly, that is conducive to 2% inflation. It's not clear to me that that rate is substantially higher than where it was before the pandemic. I would say I agree with your previous guest. Rates are very high. It's clear to me that when I look at the credit creation data coming from the Federal Reserve itself, policy is very restrictive. I'm completely on the same page as Chair Powell, Vice Chair of the FOMC, John Williams. They think policy is restrictive. Based on the data that I'm looking at, I completely agree with them.
Based on your assumptions, where's the US dollar? Politics and all of this is hard to predict, but what about the foreign exchange market? Where does that fit in?
Yeah, well, okay, you start with an easy market there, the foreign exchange market. What I would say is this, we have been biased long the dollar in our investment strategy for some time now. We haven't been pounding the table on buying the dollar against all of the relevant crosses simply because the Fed isn't super hawkish, right? It's clear that Chair Powell wants to begin the process of lowering interest rates. He's trying to figure out the exact timing. I'm not sure that's as relevant, but if he was very hawkish, it would be easier for us to propose a long dollar position against a wide variety of crosses because he would be going against the grain. Well, him and, of course, the Bank of Japan, which is on tap for later this evening as well. I would say they're not there yet. The Fed wants to begin the process of lowering rates, John, and as a result, we can't be pounding the table on being long dollars. It's just not in our ethos to do that.
Matt, it's good to see you. Thanks for dropping by.
My pleasure.
Matt Hornbach at Morgan Stanley. Coming up in the next hour of Bloomberg Surveillance, Sinead Colton Grant of BNY, Republican Senator Bill Hagerty of Tennessee, Tiffany Wilding of PIMCO, and Steve Ricchiuto of Mizuho. From New York, this is Bloomberg.
We've been calling this year a tale of two markets, but there's also been a tale of two economies, especially on the consumer side.
We're also seeing a slowdown in spending. We are talking about the softening of the consumer a little bit more.
We're already seeing signs that the economy is cooling. We think that continues and starts to have a bigger impact from a fundamental perspective.
I think this is going to be the best earnings season in 2.5 years. Earnings are going to be healthily double-digit.
The earnings have not been terrible. Granted, maybe the market got ahead of itself, but the story around earnings, the story around U.S. exceptionalism because of these companies is still retained in my mind.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, and in many ways, the week starts a little bit later this morning as well. From New York, welcome to the program. Your equity market on the S&P 500 firmer here by 0.1%, looking for a third consecutive day of gains on the S&P 500. A little bit of outperformance once again on the Nasdaq. Saw this yesterday. The Nasdaq 100 up by 0.3%. The Russell, the small caps, we'll talk about that growth rotation in just a moment. We're up by 0.1% on the Russell. And this is why for some of you, the week begins a little bit later this morning. It starts with the economic data and the earnings. Later on this afternoon, we get numbers from Microsoft after the closing bell. On the economic data side of things, later on this morning, job openings in America. Lisa, the data and the corporate results front and center.
And very much given the fact that you have 13% of the S&P 500 market cap reporting today. Yes, it is Microsoft. It is also AMD. It is also Starbucks. You get both sides at a time when we're talking about a story very consistent through all consumer-facing companies, which is they are losing pricing power. Consumers are pushing back, and it is clear there is a weakening appetite to just hoover up everything in the post-pandemic era. That is over.
We started this week by saying, is it execution within an industry, or is it just sort of across the board consumer pushback? These companies, it's really started to pile up now. I think there are some companies out there that are saying we're doing okay. We saw that from Coca-Cola, but I can tell you far more companies that are consumer-facing that are struggling versus those that are doing good.
Especially because the ones that are executing well still are only able to raise prices by 1% quarter over quarter. I'm talking about Procter & Gamble. They have Tide. They have a whole host of Pampers and Love and all sorts of other staples that people buy. They are not able to continue some of the monumental price increases that they have seen in recent years. We're going to have a debate about whether this is normalizing or not. The debate is among small caps. It is along mid caps that are beyond the tech sector. And it's in with tech, given the fact that they're not able to monetize all of the investments. So I think tomorrow we're going to have a fascinating discussion about Microsoft earnings, but we're also going to be talking about some of the consumers and how they really play out there.
I'm just going to ask the same question I've asked for like the last 6 months, which is it a welcome cooling or an unwelcome deterioration? And still at this point, through the halfway point of 2024, there's still a massive divide over all of that. It's why you hear things like weakening but not weak. It's why you hear from Bank of America who say cooling but not cool. But there are other people that take the other side of all of that.
Or that say that we're on the precipice of something that's more nefarious. And that's what you hear from Bill Dudley. That's what you hear from Alan Blinder. That's what you're hearing from Mohamed El-Arian, saying maybe this is a welcome cooling, but let's keep it that way and try to get ahead of any less welcome cooling that could come down the pike.
And Neil Data too, from Mac.
Neil,
Don't forget Neil. Equities right now in the S&P 500 look a little something like this. Futures positive by 0.2%. In the bond market, just about unchanged on 10s, 417.24. The Eurozone data really mixed. It's sort of Germany and everybody else. The aggregate number is okay this morning. GDP doing all right in Europe, but you break it down. France, Italy, Spain, good. Germany, not so good.
Which is the reason why people are baking in rate cuts. But this is a structural problem. And this really is something that people have been trying to get their head around. What did you say? It was like the Seine?
No, ING said that.
Oh.
ING said
that. Wasn't your? But it's basically like the Seine, where it's, what was the analogy here?
Sometimes you can swim in it, but most of the time you've got to worry about it.
And
was basically, I'm paraphrasing.
That's basically European growth.
GDP. Yeah.
Okay, which is really the reason why I have been sort of questioning some of the rally that we've seen in certain stocks, and that's been sort of, the sheen's been taken off. I don't know. I don't know. Germany.
Going after the Europeans today, aren't we? Need to back off from that. Coming up this hour, it's largely been driven by me, I know. Sinead, Colton Grant of BNY Wealth as investors prepare for more Mag 7 earnings. Republican Senator Bill Hagerty on potential Trump 2.0 policy initiatives. And Tiffany Wilding of PIMCO on why the Fed should begin cutting at a quarterly pace beginning in September. We begin with the big issue. The big tech sell-off taking a bit of a breather, with investors anticipating earnings from 4 mega caps worth nearly $10 trillion. Sinead, Colton Grant of BNY Wealth is still overweight large caps, remaining bullish on tech due to tailwinds from AI and free cash flow, saying the market's recent rotation is just a healthy broadening of the rally. Sinead joins us for more. Sinead, good morning to you.
Good morning, Jonathan.
Good to see you. So sticking with big cap tech, do you believe in this broadening out? Can we start there? Do you see reasons for that to continue?
Yes. A couple of them. So first of all, we want to see a rally that includes many more sectors. So when we do like tech, we are overweight large cap. We also like industrials. We like healthcare. And we talk a lot about small cap in the last couple of weeks, but let's not forget where small cap has come from, right? This is a very little unwind of some of the losses that we've seen over the last year. And let's think about why that is and when it started, because it started when we had that softer CPI print. A lot of enthusiasm around rates coming down, potentially the rate cut cycle starting. And the reason for that is because you've got that debt maturity wall that starts in small cap as early as next year, 2026. Now, let's be real. If they can refinance their debt 25 basis points lower, that really doesn't matter. But the point is, it's the expectation that we're going to see further rate cuts heading into 2025. And so that gives them much more of a breather.
That soft inflation print was coupled with a decent jobless claims read as well. I think the fact that the labour market hasn't continued to break down in a material way maybe supports that thesis even more, that the Fed would be cutting interest rates, but doing it for the right reasons because the economy was still doing all right. Do you have that faith as well? Just around the labour market, and we're looking ahead to payrolls Friday, do you have some confidence that we can stabilise unemployment in the low 4s, that we can sort of get back to target on inflation without that pain emerging in the labour market?
It's going to be very interesting to see what the data print is on Friday. So the last read being just above 4%. Let's level set. 4% is still a very low inflation number, even though it has moved up from 3.4. And so we think you're also seeing the benefit of more people coming into the labour market. You look at the participation rate, that's going up. And so all else equal, you can see the unemployment rate move up a little, but not see a broader negative effect on the economy and the consumer.
I guess that to put both of these ideas together, you're seeing margin pressure from companies that aren't able to pass along price increases, and they're talking about cost cuts. You think that's not going to cause some sort of deeper weakening that's necessarily negative. You just think that it'll be enough to trim. Is that correct?
There are two things that we need to bear in mind here. First of all, let's remember where we've come from. So while companies may not be able to put in place a 1% increase in price this quarter, for the most part, they've done 20% increases over the last 4 years. And I think consumers are just saying enough, right? They want a bit more value. So that is actually healthy. Secondly, the other reason why we're not overly concerned about the consumer is when you look at aggregate consumer wealth. Since the end of 2019, it has increased by over $40 trillion. At the same time, debt service costs for the consumer have remained below 10%. So the consumer in aggregate, yes, it's courtesy of a lot of fixed rate mortgages at 2.5%, 3%. But it means that the consumer has a lower debt service cost than the US government right now. So that's not to say that there isn't differentiation among income cohorts. Clearly, a lot more pain is being felt in lower income cohorts. But in aggregate, the consumer is going to hold up pretty well, we think.
So when you talk to investors, do they feel pretty good right now? When you get a sense of what your clients are sort of investing in, are they getting more aggressive, or are they trying to figure out how to be defensive? Is sort of the tenor of the conversation usually, how do I take advantage of pullbacks? Or is it, I'm feeling a little bit nervous, it's clear things are slowing down?
I would say there are two areas that we're really having a lot of conversations right now. First of all, consumers are feeling pretty good about the returns that they've seen in portfolios over the last few years. However, having said that, some investors still have money sitting in cash. And the conversation that we're having with them right now is rates are going to start moving lower pretty soon, even though a money market fund yielding 5+% has been very attractive. That's going to move lower. And if you do want to be more defensively positioned, then it's a great time to start thinking about getting into bonds. Because here's what we know. Bond markets don't wait until the Fed rate cut to react. The yields start moving lower in advance. And if you move into bonds a month ahead of the first rate cut, 12 months out, you've generated a return that is 2% higher typically than if you wait to move until the rate cut.
Which bonds? Because Matt Hornbach was just on of Morgan Stanley saying that it's hard for him to recommend going into longer-term bonds right now, given a lot of the policy uncertainty post-November. Which denomination are you sort of highlighting?
So most of our clients are taxable. And in the muni space, we tend to like the 10-year plus area. We do think some of the 5 to 10-year area looks interesting too, but generally slightly longer dated. And then with treasuries, we actually think that the 5 to 10-year area is looking more interesting.
Matt Hornbach, what he said about 15 minutes ago on the 10-year treasury, you can start to feel this concern about the political outcomes, November and beyond, and what they're going to do with policy and what happens with the fiscal deficit. Do you share those concerns at the longer end of the curve? How politically dependent are some of the calls for you on the bond market going further out and going deeper into 2025?
So a couple of points on that. First of all, we think that the term premium has been built into the bond market now. The key question is around inflation. So depending on which party is in power, we have Republicans and under Trump focused on raising tariffs. If you raise tariffs across the board, that's inflationary. Democrats have also talked about tariffs more selectively. But the big concern is that every time we have seen a very significant run-up in inflation, like we did getting to above 9% a couple of years ago, it's been followed by a second leg, almost invariably. And what is the trigger? So if you have tariffs across the board, that could certainly trigger it. Now, having said that, what is absolutely key is that investors do not invest with their politics. Right? So we will spend a lot of time over the next several months talking about the different policy platforms.
Yep.
What the parties are actually able to implement will depend a lot on the makeup of Congress. But what we also know is that when you go back through history, equity markets can and have done very well under different administration types. So it's not a good reason to hold off being invested.
Sinead, it's good to see you. Thanks for dropping by. Thank you very much. Sinead Colton Grant there of BNY Mellon with an update on stories elsewhere with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. PayPal shares are gaining in the pre-market trade by nearly 9%. It lifted its 2024 profit forecast, predicting earnings per share growth in the low to mid-teens, up from its prior view of single digits. The company says it remains focused on streamlining operations, part of CEO Alex Chris's goal to transform the firm. Famed short seller Andrew Left pleaded not guilty to U.S. charges that he committed fraud. It sets the stage for a high-profile legal battle over his strategies. Prosecutors, for their part, allege that Left manipulated the market to benefit his trading and made false statements to investigators. If convicted, he could face decades behind bars. The trial is set for late September. Shares of CrowdStrike down 3.7% in the pre-market. CNBC reporting that Delta has hired prominent attorney David Bose to seek potential damages from the cybersecurity firm after a botched software update that caused global IT outages. Delta fared the worst among the U.S. airlines during those outages, with days of delays and cancellations. And that's your brief, John.
Danny, thank you. Up next on the program, your morning calls plus Republican Senator Bill Hagerty as Donald Trump looks to firm up second-term policy initiatives. That conversation up next. Getting you set up for the cash open, the opening bell about 1 hour and 15 minutes away. Equity futures on the S&P positive by 0.2%. Let's get you some morning calls and kick things off with Loop Capital lowering its price target on Disney to 130 from 139, keeping a buy rating on the shares. The analyst saying the street is underestimating Disney's film profits for the second half of the year. That stock is down by 0.25%. Susquehanna raising its price target on Royal Caribbean to 180 from 160 and keeping a positive rating on the shares. The analysts saying they continue to be constructive on the cruise line. That stock is up by 0.25%. And your third and final call from JP Morgan, downgrading Novavax to underweight from neutral with a street low price target of $8. The analyst expecting little meaningful news flow from its proprietary pipeline. That stock is negative by 8.5%. There's some of the morning calls. Let's turn to the election. With fewer than 100 days until voters head to the polls, if re-elected, former President Donald Trump is widely expected to appoint a so-called Capitol Hill cabinet full of congressmen. A potential shortlist includes Republican Senator Bill Hagerty, who is being floated as a pick for Treasury Secretary. The Senator joins us right now. Senator, it's great to catch up with you, sir. We tried to do this last week, so this is our second attempt. I think this one's going to work.
Good to be back with you, Jonathan, Lisa. Thank you.
Let's start with foreign exchange if we can, sir. We caught up with the former president here at Bloomberg just a number of weeks ago. And in Bloomberg Business Week, he told us that he believes we have a bit of a currency problem in the United States of America. Senator, I would love your perspective on that, whether you agree with the former president on that issue, and what kind of policy tools you think the government has to address it.
We have a number of problems with the economy. I think the biggest one, however, and it's related, is inflation. And inflation is driving higher interest rates. Of course, that has a direct impact on our currency. But President Trump's policies will have an immediate impact to bring inflation down because he's going to end this administration's war on fossil fuels, bring energy costs down, go back to a deregulatory construct as he did in the prior administration, taking down regulatory and compliance barriers. All of these will have a lowering impact on cost here in America. It'll have a lower impact on inflation. Those will be directly beneficiary and basically help make the case then to bring rates down and therefore bring our currency into a different position.
Senator, there are two other proposals as well, which I'm sure you're familiar with. Much higher tariffs, a much tougher stance on immigration. I'm not going to sit here and say whether that's the right or wrong thing to do. I just want to talk about outcomes and consequences. Deutsche Bank, like others on Wall Street, Senator, as you know, have pointed out that tariffs and their associated stronger implications for the dollar are significantly more likely to be the dominant market outcome than policies to pursue a weaker dollar. Senator, my question to you would be, why wouldn't higher tariffs and a tougher stance on immigration ultimately just lead to stagflation?
Look, I'm fully aware of the concerns surrounding tariffs, but let me make this point. The United States of America has the lowest tariff barriers of any major economy in the world. The converse of that statement is that our major trading partners do not have the similar tariffs. They have much higher tariffs. Therefore, we have a real lack of reciprocity. That's not fair. That's something that needs to be addressed. Many of these issues date back all the way to World War II. But there's come a time and a place to step up and address them. President Trump wants to see them addressed. We want to see more reciprocal and fair trading terms. The time has come to get that accomplished.
Senator, from a market perspective, people are struggling with these two goals, sort of national security, fairness on one hand, and on the other hand, the idea of the advantage of a weaker currency for trade purposes. Which takes preeminence?
Well, I think it's something that always has to be balanced, Lisa, and I think you'll see any administration do their best to do it. I think President Trump did an excellent job of that during his first administration. The playbook is laid out there. We were strong, we were tough with China. At the same time, we brought economic growth that was twice the rate of any other major economy at the same time here in America. So we can do both. We can walk and chew gum at the same time. I think that's the challenge. The most important thing, though, is that President Trump will come in and end these reckless policies domestically that have created inflation that has caused so many knock-on effects. Again, back to energy independence. We need to get there. Not only will it be important for lowering inflation here, but it'll be an important geostrategic tool as we become much stronger allies who are able to export our energy to places like Europe and Asia.
All right, let's go there. You've mentioned it a couple of times, this idea of a war on fossil fuels, as well as the idea of not really achieving the goal of energy independence. We're pumping more oil in the United States. We're producing more oil than ever before, more than 13 million barrels a day. This is something unseen before in terms of production from any other nation. How can you say that it's a war on fossil fuels at a time where it is record production?
Lisa, it clearly is a war on fossil fuels because Joe Biden came in and took federal lands off the map immediately upon taking office. That's a quarter of our capacity right there. What you're not saying is that there was a trajectory that was much more rapid, much higher. We took ourselves off of that growth trajectory and we flattened it. We continued to produce, but demand is outstripping it. Think about the demand for electricity here in America. If you think about what we're going to need for artificial intelligence, the electrification of the grid, we've got to get back into the energy production business full blast. We have the technology to do it. This administration has done everything they can to slow that down. We need to get back on a rapid growth path. That'll put us on a trajectory to be not only stronger here domestically and lower inflation, but also stronger partners with our allies.
So, Senator, right now we're producing 13.3 million barrels of crude every single day. As Lisa pointed out, that's a record. It's more than anyone on the planet. How much crude do you think America should be and can be producing?
We should be producing more than anybody else in the world, as we are. We need to produce more LNG, and we need to become the strongest energy partner there is. You think about pipeline capacity and the difficulty of getting permits of this administration. You think about the difficulty of getting a refinery started here in America. All of these log jams and difficulties make it less possible for us, make it more difficult for us to be the best possible ally that we could. We need to expand it. We need to realize that this is a true source of competitive advantage for the United States of America. Let's exploit it.
Let's talk about who is an ally and who isn't an ally. There's lots of conversations about what's going to happen with trade policy and China. I think we've sort of exhausted that conversation many times over the last few weeks. Senator, I want to talk about Mexico. I want your view on Mexico. We saw from Elon Musk of Tesla that he's holding back investment decisions in the country because he thinks there might be a change in the next year that makes it difficult to produce automobiles over in Mexico. We've heard similar thoughts from auto manufacturers elsewhere worldwide. What is happening in Mexico and what kind of changes would you like to see?
Well, in 2026, the USMCA is up for renegotiation. I think one of the greatest concerns is the fact that Chinese EV makers are looking to end-run the end-run tariffs and use the USMCA and Mexico market in particular as a means to get into the U.S. market, and they're using their subsidized product destroy the U.S. market. That's going to have to take a very solid look. I think also with respect to Mexico itself, we've seen some very concerning behavior there. The prior administration there under AMLO actually nationalizing American companies' assets. We've got to address that. I intend to speak with the new administration there very soon about what we can do to make certain we have much better and much stronger relationship there with Mexico on fairer terms.
Senator, the last time we tried to talk, you were at a Bitcoin conference, and this was our cryptocurrency conference, and that was where the former President Trump was speaking and fundraising. And we've been asking this question on the show. Why Bitcoin? Why now? Why crypto assets? What's sort of the motivation to really embrace a network of crypto assets and become the preeminent network on the planet? From a Republican sort of stance, is this something that is concrete, and why?
Lisa, I think this is something that has evolved over time. I first began looking into crypto in the previous administration in 2018. That was my first engagement. I initially started at a point of skepticism, as I think many of my colleagues do. But when I began to understand the underlying technology and realizing the potential for dramatic productivity gains, what I thought to myself is we need to make certain that it happens here in America. The last thing we want is to see what happened with the semiconductor industry, where it got pushed offshore and weakened us from a geopolitical standpoint. We need to see this innovation happening here. I've been in many conversations with President Trump. His thinking is likewise involved, and he's embracing the fact that this has tremendous potential for America. We want it to evolve here. We want to create the ecosystem for it to thrive here. And the last thing we need to do is push it offshore. However, the current administration has done everything they can to attack this industry, to push it offshore, again, to use the SEC, the CFTC, every tool at their disposal to come in and attack this industry and refuse to provide it with any type of regulatory framework. President Trump made the statement at the Bitcoin conference that one of the first things he'll do is change out the administration's leadership. Gary Gensler, he said, will be fired. That brought people to their feet in applause. He's going to end Operation Choke Point that's been taking place in the crypto industry here in America. And he's going to try to create the environment here where the industry can thrive, and we'll see the next wave of innovation happening right here in America.
Senator, we've got to dance around the issue about your future, so this is how I frame it. I've got 20 seconds left on the clock. Your favorite city to live in, Nashville, Tokyo
Absolutely.
or Washington, D.C.? Which one?
No, it has to be Nashville, Tennessee. And if you'd been there at the crypto conference, you'd have seen the energy there. It is absolutely wonderful what's happening broadly across my state. That's why so many people are moving there.
Senator, thank you, sir. Senator Bill Hagerty there on the latest with crypto, the economy, trying to work out whether, he'd entertain a move full-time to D.C., maybe in Treasury.
You think he would say anywhere else other than Nashville?
Bramo,
He's a Nashville kind of guy. It's his state.
Figure these things out as the months go by.
It's graceful. Beautifully done.
It's as graceful as I could possibly be. From New York City this morning, good morning. This is Bloomberg. It's my favorite line in US politics. There's a war on fossil fuels. Republicans say this, and Democrats say, yes, there is a war on fossil fuels because they want everyone to, they want their supporters to think there is a war.
That's a great point.
On fossil fuels. And what gets lost in the conversation is what you did, which is like, well, hang on a minute. There's 13.3 million barrels a day of crude being produced in this country.
Yeah, well, and there's one side that says it could be more, and another side saying, shh, don't talk about that.
Right, it's this convenience argument that they sort of have. Like, there's a war. Yes, there is one.
Yeah, it's very confusing.
And then both sides are happy.
Yeah, well, it's basically a messaging tool. Who's going to be happy? Yeah.
Which is another reason why you love politics, right? Yeah. Okay.
Let's leave that there.
Equities look like this on the S&P 500. We're looking at 3 days of gains potentially. We're lifting up by about 0.1%, a little bit more than that now on the S&P 500, up by 0.2% on the Nasdaq 100. Lots to talk about in the bond market. Potentially a fourth day of declining yields on a 10-year yield. Your 10-year at the moment, that maturity just about unchanged at 417.63. The 2-year doing absolutely nothing. In at around 440, 439.97. I want to finish on foreign exchange. Just two things to talk about. GDP in Europe came out okay. Germany, not so much. Everything else did the heavy lifting. The everything else being France, Spain, and Italy. The euro's just about unchanged at 108.16. Lisa, dollar yen, the big one overnight. Interest rate hike, yes or no? QT, how much will we get?
Basically, this is the reason why the Bank of Japan might be a more consequential meeting from a market perspective, at least near term, than even the Federal Reserve. If they don't hike rates, man, I'm getting all confused. If they don't hike rates, that could lead to a pretty significant reversal in some of the strength we've seen in the yen over the past couple of weeks. If they do, is it going to be enough? Can they offset any kind of lack of a rate move with balance sheet? All these questions that people say could potentially really kind of shift the yen around.
How did Matt Hornbach frame things? He had that Olympics quote. What was the Olympics quote?
Oh, it's fantastic.
Stronger together. What was it?
It's great. So the Olympic motto reads, faster, higher, stronger together. It could have also been used as a motto for central bank policies, inflation and growth in 2022 and 2023. Slower, lower, weaker, together could easily be the mantra for today.
Can we challenge that last word, together? How divided is the rate cutting cycle going to be between the ECB, the Federal Reserve and the Bank of England? How synchronized is this actually going to be?
It's a great question. And this has been a debate for a lot of people. They basically say people can move at different times, but it has to be generally kind of in the right direction. I will just point out, we talk about slowing growth and actually a negative growth read when it comes to GDP in Germany. And we did just get information on harmonized CPI rising more than expected in Germany, 2.6% versus 2.5%. So does the balance of risks in Europe look very different than the balance of risks in the United States when, hey, they are not pumping 13.3 million barrels of oil every day, and they are dependent on other sources for fuel. This is some of the, sort of backdrop to why it's very confusing.
This is where the Republican senator had quite a strong point around being
Correct.
A strong ally.
I would agree.
On things like LNG. These are some of the criticisms that we've seen levelled at the current Biden administration. Just how much of a strong ally have they been with the Europeans? Will they be with the Europeans over this kind of energy production and energy supply?
I'm glad you went there. The idea that LNG was limited at certain points as far as exports to Europe at a time where they need liquefied natural gas in order to offset some of the lack of supply they've been getting from Russia, that raises some questions about the alliance, just the strategic position, understanding that the goal was trying to reduce inflation domestically, at least heading into the election. That is something that is worthy of a real discussion that a lot of people are having.
That's the latest in the market, some of the broader conversations in and around it. Under surveillance this morning, we need to talk about this. Mag 7 earnings picking up again after the closing bell. 4 mega caps worth $10 trillion reporting this week. Microsoft, Meta, Apple and Amazon. Investors waiting to see if billions in AI spending is paying off. And we're all waiting to see how patient investors will be a little bit later this afternoon in the face of it.
Yeah, I mean, this basically comes down to a timing thing. Are we talking about CapEx that is useless, or are we talking about CapEx that isn't being rewarded right away? So why should I hold this, given the fact that there are other things that I could potentially make more money in? There was this statistic from the Bank of America that for every additional $9 spent in CapEx, you see only an additional $1 in sales for hyperscalers. In other words, you're not seeing it monetized maybe as quickly as people expected. And patience is not a word I would use with a lot of traders that I think would be looking for earnings to outperform.
We'll see how much patience there is a little bit later this afternoon and into tomorrow morning. I want to mention Samsung just briefly, closing the AI memory chip gap with its main competitor, winning NVIDIA's approval for a version of its high bandwidth memory chips, the advancement coming after months of setbacks for Samsung, which has historically led the way in the memory chip market. That's the latest on that front. Beyond big tech, investors also awaiting the Fed decision. The FOMC's two-day meeting kicking off today. Fed Chair Jay Powell widely expected to give a soft signal for a September rate cut. To discuss, Tiffany Wilding of PIMCO joins us alongside Steve Ricchiuto of Mizuho. To the both of you, thanks for being with us. Tiffany, I want to cross over to you first and get your thoughts on what we can expect tomorrow afternoon, what kind of changes you're looking for in the statement and what you expect the chairman will emphasize in the news conference.
Well, I think he's going to say that they are more confident that inflation is starting to move back towards their goal after progress had stalled in the first half of this year. Of course, the fact that shelter inflation has shown more progress in the last few inflation prints is going to help in that. But I don't think that they're going to, I don't think they're going to be in a huge rush. We think they are going to signal a September cut. But the economy appears to be doing okay here. So, I think, in terms of market pricing, the Fed is very focused on, I think, cutting maybe at a once a quarter pace, taking it slow at least at first, unless the economy appears to be rolling over more heavily. And I mean, it doesn't. So, I think he could actually come across as being a bit more balanced. Although we do think they are going to cut in September relative to what markets are pricing.
We don't get an update to their assumptions, their forecasts this time around. We'll get them in September, I believe. Tiffany, I'm looking at their current forecast for unemployment. They've got that for 2024 at 4%. That's below where we are right now. You mentioned maybe them going in September and cutting once every quarter. What would your assumptions be in the labour market for unemployment, given that's your call for interest rates?
Yeah, I mean, so we think unemployment probably ends around where it is now, 4.2, maybe a little bit higher. The labor markets are normalizing, but we think the important fact here is that you haven't seen a lot of, actual layoffs. If you just look at the level of employment, has not really declined. Those are usually the hallmarks of recession. So, we think we're seeing a labor market here, which is easing, certainly. We've had a lot of supply, more supply coming into the labor market as a result of immigration, and that appears to be the story to us. And I think that still allows them, to kind of, cut and do it at a pace, that isn't hurried like we see in a recession.
Steve Ricchiuto, I know that you're sympathetic to the view that they don't have to rush. You've been talking about the potential for no cuts being actually okay for 2024, given the fact that there's plenty of momentum under the hood. Do you still feel that way, that, frankly, all this talk about even cutting rates tomorrow is premature, and that you think they should really hold off and be more patient than many people think?
I mean, to answer your question real specifically, they're winning. They're winning without having done anything, which is the most interesting aspect of this. The promise of rate cuts has led to financial market conditions which are much more accommodative than the federal funds rate implies. So therefore, there's a question as to whether or not they actually have to adjust the federal funds rate. The reality is they run the risk, if they do adjust the federal funds rate, of people over anticipating what they will do. I think they would be very happy over the long term with a gradual reduction in rates, but you've got a Federal Reserve that is dominated by political economists who are very, very much sympathetic with a much more aggressive monetary policy reduction, and therefore the market reads that and is likely to say, okay, once they cut, It's not going to be every other meeting. It's not going to be once a quarter. It's going to be every meeting. And that's why when you look at the forward structure of rates, for example, SOFR going out over the next year or so is telling you that the market's assuming we're going to get to a 2% Fed funds rate, where I think a lot of economists would be sitting there saying, well, maybe we get to 3 or maybe we get to 3.5. The reality is the market's priced in much more, which is why financial markets are so accommodative, which is why they're winning without doing anything.
Steve, you said political economists and that they're in favor of a much more aggressive rate cutting path. Can you tease that out? Because some people might hear that and say, okay, they want to cut rates, that they support an administration or another. Is what you're saying a little bit different?
Yeah, I mean, you've got people here who are policy wonks. They want to play with the levers of monetary policy. They want the idea, the administration likes to play with the levers of fiscal policy. This is a throwback to the 1950s, 1960s, where we had a group of economists that came in that thought they could use, monetary and fiscal policy to craft an economy more suiting to their liking. And we're trying to do exactly the same thing here again. Now, the results of what happened in the 60s and 70s was we wound up with a stagflation environment, which we're not anticipating here because we had a world of excess demand there. We have a world of excess supply here. But the reality is you could wind up with a higher rate of inflation than the market is discounting. I think the biggest risk for the market is not at the front end of the curve. It's at the long end of the curve, because yields at the long end of the curve are not taking into consideration the risk that what these policymakers are doing runs the risk of creating an embedded higher inflation rate than is currently priced into the long end of the curve.
Steve, are you suggesting there's more chance that 10s trade in the 5s next year than they trade in the 3s?
I think that's exactly the right scenario to think about. That is the risk-reward trade, yes.
Tiffany, you're at the bond house. What are you and the team doing with regards to that? How are you thinking about the challenges to the long end of the curve in 2025?
Yeah, I mean, we certainly think that over the longer term, markets can price in more, just more term premium, as a result of the outlook for the U.S. federal government deficits and debt. Clearly this is, we're on an unsustainable trajectory. That trajectory is the result of, Social Security, liabilities in the future, and these non-discretionary programs, the U.S., those will have to be course corrected at some point. Obviously, the big loser coming out of the pandemic was the government balance sheet with additional debt. And at some point we agree that the markets will need to price in some more term premium for that. But at the end of the day, and you can get a steeper interest rate curve, but at the end of the day, we think that government policymakers, maybe not this administration or the next, eventually they will do the right thing and we will, get some course correction. And we think the markets are currently giving the U.S., that longer term fiscal credibility. So, I mean, ultimately, I think it's nuanced discussion. We think the curve can steepen, so more term premium can get priced, but we aren't expecting, some messy volatility to result from this.
Tiffany, what do you make of Steve's argument that these officials on the Fed are political economists who harken back to sort of some of the philosophies of the 1950s and 1960s of fine-tuning everything? So they're going to be more prone to trying to support a market and being a put, essentially, the way that they're being treated in markets right now as sort of, either way, it's going to be okay because they can come to the rescue. Do you kind of find sympathy with that view?
Well, I mean, I think that now that inflation has moderated quite a bit, and now that people are more confident that you are still going to get some additional moderation, it could be slow, probably will be bumpy, might not get core PC inflation all the way back to 2, but could live with it in a 2-point-something zone. The Federal Reserve officials, as they should, are going to start to focus more on, the labor market side of the mandate. And, the view over the last, several years, I would say, and even in the long-term strategy review that was completed several years ago, the view was that if you let the labor market run a little bit hot, it's okay for the economy. It's actually good. You have people coming back to the labor market. You have underserved communities, that really start to benefit from that. And I think that's certainly the kind of policy views that people have. And as a result of that, they will be quick to start to to drop interest rates, I think, if you do see a labor market that's loosening or rolling over more than they expect.
Steve, I want to just finish up with you because there's this question about what the consumer is doing based on some of the corporate guidance that we've been getting. It's been sort of highlighting the pricing, the lack of pricing power at a lot of different companies. And pointing to this question, as John's been asking repeatedly, and rightly so over the past 6 months, is it weakening or weak, cooling or cool? Are you changing your view on whether this is actually truly a less perhaps heated economy than you thought, say, a month ago?
No, I think the economy is still going to see an inflation rate at the end of the year that's much higher than the Federal Reserve's target. I think the hope that the currency continues to provide the ability for global goods deflation to dominate on, or to have an impact on the favorable impact on the domestic inflation story is a risk. Foreign central bank policy decisions can have an important impact on the currency. It's not just the U.S., and the currency has been one of the critical components here. If the dollar were to take a turn to the downside, and you were to take, for example, your DXY measure, and you were to head it back towards 100 from the 104, 105 area it's been trading in, you could have a significant impact on goods inflation. And if you had a significant rebound in goods inflation, you would have a significant bounce in inflation. And therefore, it's not just the monetary policy decisions here, it's the monetary policy decisions overseas. And that's why you shouldn't rely on that component to be the component that drives your inflation story, especially when you want to keep a labor market hot. This concept of a hot labor market gets to the question of, well, what is a hot labor market? The natural rate of unemployment had always been seen to be 4.5%. Now suddenly we've lowered the target for where the unemployment rate should be by the end of the year to 4%. That's a very significant downward adjustment in the unemployment rate. So yes, the Federal Reserve lowered the threshold to make it look as if the labor market is accommodative or becoming more available, or the slack is developing in the labor market more quickly than is actually taking place. And this is a critical component. You look at the claims numbers, you look at the continuing claims numbers, you look at the number of job layoffs. People are not getting fired, and it's harder and harder to find skilled workers. Wage pressures aren't coming off the boil. It has been really an environment in here where global goods deflation has been pulling down the headline inflation, just like global goods inflation moved a lot of it up to the upside during the COVID environment. It's now reversed that. But by the same token, the service component is not coming down, and the service component is the dominant component within the U.S. inflation rate, because we are much more of a service economy than we are a goods economy.
Hey, Steve, Tiffany, big week ahead. Thanks for giving us some time this morning. Steve Ricchiuto there of Mizuho, Tiffany Wilding of PIMCO, two of the very best in the world of economics. Looking ahead to some jobs data a little bit later. Job openings coming at 10 a.m. Eastern time, so in about an hour and 15 minutes for the month of June. Then a ton of July economic data. We'll get the ADP report tomorrow. The day after that, we'll get jobless claims. Then it's payrolls on Friday. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, Procter & Gamble shares lower pre-market. Quarterly sales miss estimates, rising just 2% versus expectations of 3.4%. P&G struggled to push through price increases in its household items, raising prices by just 1% in the quarter. That is the lowest increase in nearly 3 years. It does rhyme with Kimberly-Clark's earnings, which also missed on sales in its report last week. Warren Buffett's Berkshire Hathaway cut its stake in Bank of America again. The company disclosed its third sale of Bank of America shares this month, pairing its massive bet on the lender by a total of more than $3 billion. Still, Berkshire holds almost 962 million shares. The filings show worth $39.5 billion at Monday's closing price. Buffett is taking profits with the stock up 22% this year. And it's day 4 of events at the Paris 2024 Summer Olympics, with finals in fencing, judo, rugby, sevens, gymnastics, and swimming. In tennis yesterday, Novak Djokovic ended Rafael Nadal's singles run, beating him in their 60th and possibly last head-to-head match. For the U.S., the men's gymnastic team clinched a big win, taking home bronze for its first medal since 2008. The U.S. is leading the overall medals count with 20, 3 of them are gold. Meanwhile, Japan has 6 gold medals, 12 of them overall. And that's your brief. John.
Danny, thank you. It was sad watching Nadal. I don't know how much of you saw it, but it was sad. I hope he gets it done with Carlos Alcaraz.
I got to be
doubles.
completely honest. I actually wasn't watching that. I was watching gymnastics.
Okay.
I was even watching like the ribbons.
I watched some of the gymnastics too. I didn't watch the ribbons. Don't know what that is.
I watched the ribbons,
Okay.
which is really quite amazing. I watched synchronized diving.
Oh, you were busy yesterday afternoon. I was getting ready for the show.
Yeah, well.
Up next, I was doing the same thing, as you can tell, maybe. Up next on the programme, we'll run you through the day ahead, the week ahead, and we'll get some thoughts on the baseball with David Rubenstein. Look out for that next from New York. This is Bloomberg. The open in Bow, about 40 minutes away, with equity futures elevated by just 0.1%. We're higher on the S&P 500. The day ahead, the calendar, the trading diary looks like this. At 10 a.m. Eastern Time, we'll get JOLTS and consumer confidence data Wednesday. Tomorrow, we'll get ADP plus decisions from the BOJ and the Federal Reserve, followed by a Chairman Powell news conference at 2:30 Eastern Time. Thursday, another round of jobless claims, plus another central bank decision, this time from the Bank of England. And on Friday, the main event on the data side of things, we'll get the US payrolls report. Earnings picking up later this afternoon with Microsoft after the closing bell, ahead of Meta, Apple and Amazon. All of that coming up over the next couple of days. Also coming up later, David Rubenstein sitting down with Dmitry Balyazny, the founder and CIO of Balyazny Asset Management. You can watch that on Bloomberg TV at 9 p.m. Eastern tonight. I'm pleased to say that the host of Bloomberg Wealth, David Rubenstein, joins us now for more. David, not in your typical office, not in the Washington, D.C. bureau. You were at, I believe, Camden Yards. I think we have to address the elephant in the room, David. We've got to talk about the baseball. How much are you loving life right now?
Well, we are in first place in the American League East. We have a really good chance of going further into the playoffs this year than we did last year, and so I'm very happy. Obviously, we're not always happy. We lost last night, but there's a game again tonight, and there'll be a game again tomorrow, and so hope springs eternal.
You're going to be, of course, focusing on the trade deadline as well. And David, before we move on to other things, I am just wondering, has this satiated the sports itch, or are you still in the market looking for other things?
I think this is taking enough of my time now. I think, I probably am not going to go buy anything else right now, but this is a very enjoyable thing to do, and I'm quite happy with the team and the way they're progressing. Yes.
David, I honestly don't know where you find the time to do all of the things that you do. You did interview Mr. Balyazny in an interview that was really fascinating. I recommend that everybody watch. He talked about his background coming here from the former Soviet Union, from Ukraine, during the time 1990s when he could, and the difference operating there versus operating here. What did he tell you about the importance of the political structure to what he could do?
Well, he escaped with his family at the age of 7 from Kiev, came to Chicago, couldn't speak English, nor could his parents. Ultimately, he became a financially successful person and runs Dmitry Asset Management, now known as BAM, which is one of the largest multi-strategy hedge funds, and multi-strat hedge funds, as they call it. It's like Millennium or like Citadel. They have different teams of people. He has 170 different teams of people pursuing different investment strategies, and each one is uncorrelated with the overall market. And so it's a very efficient way to, I guess, manage your money. He's got now about $20 billion under management. And as you noted, he's the chief investment officer and the founder. Company's based in Chicago, but large offices in other places in the world. And he's a very impressive person. He's also given a lot of money for Ukraine relief because of the war. He's obviously has connections, family connections, go back for a long time into Ukraine. He's a person who, relatively modest in his demeanor, very smart, clearly, and I had a really interesting conversation with him. Many people I interview I knew before. I really didn't know him, and I was impressed with his ability to articulate what he does and also with the success of his firm. It's quite amazing that he's built this from scratch without having a degree from a famous university or without having been a native of the United States.
What was the most surprising thing that he told you during the interview?
Well, he told me that he couldn't speak English at all when he came here, nor could his parents, and he really didn't really have any connections to get anywhere. And where he got and how he got off the ground was that he answered an ad in a newspaper. Just saw an ad in a newspaper looking for help, He got an entry-level job at a firm in Chicago, and he basically used that entry-level job to learn the trading business. And then when he wanted to start his own firm, the person who owned the entry-level company that he joined became one of his investors. So it's really a success story. Typically, it's a great American success story, an immigrant story coming from nowhere to build a very, very large, I'd say, financial service firm. Quite impressed with him, very articulate and very modest in his demeanor. He doesn't flash his money, he's very low-key and quite impressive.
Just a phenomenal story. I'm really looking forward to watching this a little bit later. David, good luck against the Blue Jays later on this afternoon as well. David Rubenstein there of the Carlyle Group. You can watch David's interview with Dimitri Balyasny Asset Management founder and CIO on Bloomberg TV at 9 p.m. Eastern tonight. What a story.
Yeah, especially considering the fact that he came from nothing. I got to say, it's also quite a story that David Rubenstein is, at Camden Yards, just
like
living
with his
life.
baseball team in the
He's
background.
just like, yeah.
I was going to say, if you're interested in, I've got a club in the north of Italy that I might want to sell you.
You're trying to market AC Milan? Really?
Tomorrow, Julian Emanuel of Evercore, Dan Ives of Wedbush, Emily Rowland of John Hancock, and former St. Louis Fed President Jim Bullard. Fed Day just around the corner.